It's still a moving target with the tariffs.
Even the trade deals that are struck, they're still not very detailed.
We're at really high tariff rates right now. In our minds, the next signal points upward.
There's still a lot of story to be told. There's still a lot of negotiations to go on.
It's not a pretty thing to watch, but I think the markets have figured out that this is going to get resolved in the next few months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, no extensions.
We didn't move down. It's always been August 1st. They didn't make a change. Clarification, maybe August 1st they pay. And everybody pays. If they want to buy and make a lot of money and sell in the United States, they have to do that.
President Donald Trump stressing he won't be offering additional extensions. The White House vowing to push towards a 50% tariff on imports of copper, and the race to take Fed Chair Jay Powell's seat narrowing down to the two Kevins. The risks are building. Equities are looking right through it.
You know, this really comes down to the headlines are scary, the numbers are scary, but people have seen this movie before and they're viewing this as a negotiating tactic, which is the reason why equities just are not blinking. And possibly, and this is the important thing, maybe trading partners aren't blinking either. We aren't getting any details with the 50% copper tariffs. There were no even, presidential memos put out on this. It was an off-the-cuff comment. And this may be a way of getting more leverage, escalate to de-escalate ahead of August 1st.
The 2 days of very mild losses on the S&P 500 compared to the 2 days after April 2nd, down 5%, down 6%. It's nothing like it this time around.
It's not, and it feels like almost the boy who cried wolf. The market is saying, yes, we hear you. You're going to try for this maximalist approach when it comes to negotiating, but we don't believe you're going to follow through, which is why even when the president took to Truth yesterday and said it is going to be August 1st, no ifs, ands, or buts, the market just sort of shrugged it off. What's interesting about copper is that we knew this was coming down the pipeline, right? This has been a national security concern the president has talked about since February. It's the 50% that has people on edge. And the questions, given your point that this was just an off-the-cuff comment, no details, will there be carve-outs? And what kind of timing are we looking for when this can actually hit?
Well, let's sit on copper. Potentially the global market's going to be split in two. And in theory, and I stress in theory, higher prices should stimulate domestic supply. In theory. But in practice, we know the issues that we've got here in America. We've got the deposits. We've got a regulatory problem. A lot of these things have been wound up in the courts, stuck in the courts for the best part of a decade.
Yeah, we have seen these mines, particularly in the southwest of the United States, that haven't gotten off the ground for, as you say, more than a decade. Can they get the regulatory approvals quickly enough to actually generate the output? And as Annmarie is shaking her head, a lot of people think that this is going to really penalize industrial United States just at a time when this presidential administration is trying to ignite it.
And there's going to be higher prices because the U.S. does not have the copper it needs when it comes to its own manufacturing. And you're saying, how long can this take? Even if you have a deregulatory environment, it doesn't take months, doesn't take years. It takes decades when you're looking at potentially building out the entire supply chain when it comes to copper.
Should we talk about the two Kevins?
Yes, please.
Kevin Walsh, Kevin Hassett, narrowing down to two in the race to replace Chairman Powell, according to the Wall Street Journal.
With some people moving away from Kevin Walsh, given his hawkish past. Ultimately, this is a president who's come out and said, I want a Fed chair who's going to lower rates and lower rates a lot. Too late has been too late, and that's what his new moniker for Jerome Powell. This, to me, I think is arguably one of the biggest stories out there. Because if you have the inflationary push from some of these tariffs, if you have an economy that's still okay, and you have a Fed chair that's being selected purely on their willingness to lower rates significantly on the front end, what does that do to inflation? What does that do to rates? And how much this really speaks to the reason why increasing numbers of notes are coming out and saying, we prefer European government bonds to U.S. ones.
BlackRock said exactly that. We'll catch up with BlackRock a little bit later on this morning. Fed minutes coming later on this afternoon. Look out for that and look out for this too. $39 billion in 10-year notes coming to market. Some important supply for this Treasury market. Coming up on this hour, we'll catch up with Keith Lerner of Truist, with stocks looking to snap a two-day slide. Scott Lincicome of the Cato Institute on a major 50% copper tariff, and Andrew Sheets of Morgan Stanley on the race for the next Fed chair. We begin this hour with our top story. President Trump promising more tariffs and no extensions. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Yeah, hey, John, good morning. Well, President Trump says that we can expect 2 waves of additional tariff letters to go out today. He says a minimum of 7 countries will receive them this morning, followed by a second batch this afternoon. As he doubles down, this is the last chance for them to negotiate, appearing to walk back what was perceived flexibility earlier this week, where he said that August 1st was firm, but not 100% firm. And now he says that there will be no extension. He told reporters yesterday in the Oval Office that these tariff letters could outline rates as high as 60 or 70% for some countries, though declined to give specifics beyond that. That would, of course, be significantly higher than the marginal differences that we've seen outlined in these letters so far. When it comes to who we're potentially watching that could receive these letters, he did say that the European Union could be on the list, considered to be surprising since our understanding of these letters is that these are the trading partners that the White House at the moment is the most frustrated with when it comes to negotiating. But it does appear that this really is the administration's last push to get the best offers on the table. And our understanding has been that the EU has been making progress, with people familiar telling Bloomberg News earlier this week that they were nearing a technical agreement in principle. John, we know at the heart of those negotiations really has been those sector-specific tariffs enacted under Section 232 on the basis of national security concerns, particularly when it comes to autos and steel that are already in place. But as we get this new threat about copper and pharmaceuticals, that no doubt is ramping up the pressure and unwelcome news to our trading partners as they sprint ahead to get a deal by the end of the month.
Tyler Kendall down in Washington. That's the situation in the nation's capital. Here's the view on Wall Street so far this morning. Keith Lerner of Truist writing the following. It's been a year that began with our annual outlook, a bull in a china shop. And while things did break along the way, the bull kept charging. We would stick with the primary uptrend. Keith joins us now for more. Keith, welcome to the programme, sir. Let's go through this. The president's threatening some big levies, some extra tariffs, and yet equities are still very close to all-time highs. So I'll give you 3 options. Either the market is just looking right through it and doesn't believe the president, or tariffs don't matter, or this market is offside. Out of those 3, Keith, which one speaks to you?
I think 1 in 3 speaks to me. It's kind of what Annmarie said earlier. It's kind of like, fool me once, shame on me. Fool me twice, fool me once, shame on you. Fool me twice, shame on me. Sorry, I messed that up. But so I think the market's become somewhat numb to this, and they know back in April when the market sold off because of this, a lot of people or institutions were off sides, and other markets come back, and we still have seen normalization in positioning, but still somewhat underweight. So I think investors at this point are hesitant to go on defense again. Now, the other point I'd make is, we've been going through this carousel of concerns all year long, whether it's geopolitical or tariffs or what have you. And I think we also have to don't lose sight that, tariffs do matter. What happened with copper does matter, but it's not the only thing that matters. Tech still matters. We have corporate earnings season coming up as well. And we've seen corporate America prove very resilient over the last, several months and several years, in fact.
It seems like, Keith, there is this viewpoint that's been coalescing over the past few months that stocks are in a better position to weather all of this than bonds. Do you think that still stands, that essentially is the landscape at a time where we've seen that inflation can be good for stocks and that companies, particularly the biggest ones, have adapted and adjusted?
I think on the margin, that's true. I mean, we do have to recognize that as the market has come up, valuations are back to a 22 multiple on the S&P. Even though stocks are an inflation hedge, we also have expectations that have come up. So, overall in our portfolios, we're more aligned with our long-term targets of stocks, bonds, and cash right now. But we do favor large caps in particular because of what you just mentioned, the adaptability. And all in all, when we think about this year, another thing that's still positive, the forward earning trends continue to move up. So I think the market has earned the benefit of the doubt. And even though we will likely see some more broken glass in the China shop, I still think this kind of uptrend deserves that benefit of the doubt.
Okay, so that's the stock market. Let's talk about the bond market, especially as the two Kevins go to Washington, D.C. and plead their case to be the next Fed chair. I'm just wondering how concerned you are about the credibility here and the possibility that there could be a chair that jawbones the committee into lowering rates substantially at a time where there still are inflationary pressures and the economy is still chugging along.
It is a concern. I mean, right now the 10-year Treasury is around 440. It's interesting, despite all the news on copper overnight, it's basically flat, and it's been in a range for some time. I think that's helped the equity market. If the market got concerned that we would, artificially move rates lower, then you could see a steep and more concerns about inflation, and that could be problematic for the overall equity market. But I would also remind folks that it's not just one person at the Fed, right? There's 12 voting members, which you might start to see is more division within the Fed. And it's not a locked sense that you could have someone that comes in and automatically just cut rates aggressively. Now, you could have more of a bias that way. But again, it is a committee of 12.
There's a lot of questions going into the fall. When it comes to the tariff extensions, before we get to the Fed chair, which those interviews are already starting to take place, if Trump says there's going to be no extensions, and we do see these rates, particularly, say, with Japan and South Korea, stay, does the market just absorb it, or will they actually start to push back come August?
I think as we get closer to the deadline, even if it goes through, if we start to see from it sticking for a couple of days to a couple of weeks, I think the market will start to feel that, and it will have a hit, because right now the market is basically assuming that things will get done. I mean, and that there will be a negotiation. If we do see things that stay at a higher rate for a prolonged period, especially with some of our major trading partners, then I do think that you'll see hiccups, especially as you move into like August and September. Tends to be less liquidity, tends to be seasonally a more challenging time. But at the same time, I don't think we're going to see necessarily a replay of what we saw in April, where this was, all new. I think you could see maybe a pullback 5-10%, but unlikely at the same extreme. Now, the one thing, even with, right now, the president probably feels somewhat emboldened in that, markets are back at an all-time high. We have had employment that's been somewhat solid here more recently. So if you're going to press against your trading partners for leverage, he probably feels a little bit more emboldened to do so when the market is back to all-time highs and the economy seems like it's doing just fine.
Putting these two stories together, and to build on Lisa's point about the Fed, could we see by September the equity market pushing back on his tariff policy and the bond market pushing back on what he wants to do when it comes to the Fed chair?
No, that's certainly a risk for the overall market. But again, I think this is going to stay front and center, especially over the summer. But I also want to lose sight of what we still see as the dominant theme of this bull market, which is technology and AI, which is over 40% of the S&P. Doesn't mean that that there won't be a negative impact, but don't forget the earnings are the main driver of stocks over time, and at least on the service side and the technology side, those will likely continue to move up because there's a secular theme that if you don't invest in AI and tech, that you're going to be left behind. And we're starting to see a pickup in companies and corporations using AI and leveraging it. So yes, it will matter. Definitely a short-term hiccup for the market, but I don't think it necessarily ends the bull market itself.
Hey, Keith, appreciate the update. Keith Lerner there of Truist. Just on that final note from Keith, a lot of people freaking out about tariffs. Look at Mark Zuckerberg. Taking talent at $10 million apiece. That's not a man who's worried about tariffs.
Because ultimately, we've talked about this before, AI is not necessarily tariff dependent. This is dependent on price insensitive buyers that have to keep up with the recent trends.
Except I wonder what kind of pushback we could see when the semiconductor sectoral tariffs come down the pipe when it comes to these 232s, like we saw with copper and Trump floating with this idea of 50%.
Stock's still very close to all-time highs. Futures this morning positive by about 0.1%. With an update on stories elsewhere with your Bloomberg brief, let's cross over to Lizzie Burden. Hey, Lizzie.
Morning, John. President Donald Trump has vowed to push forward with his aggressive tariff regime, stressing his August deadline is final and he'll not be offering additional extensions on country-specific levies, instead hardening his tariff threats on copper and pharmaceuticals. Elsewhere, investigations are underway in the deadly Texas flash flood. They're looking into when weather forecasters advised local officials about the flooding and what those officials did to spread the message to the thousands in the area. The floods killed over 100 people and 161 remain missing. And Amazon Prime Day sales have suffered an early slump. Momentum Commerce reporting a sales decline of nearly 14% in the first 4 hours of the event compared to last year. Prime Day stretches over 4 days this year, up from 2 in 2024, making year-over-year comparisons somewhat tricky. But in the initial hours, they are seen as a key indication of performance. And that should be my brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, more tariffs.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. They're going to be tariffed at a very, very high rate, like 200%.
In just a moment, we'll catch up with Scott Lincicome of the Cato Institute. Live from New York City this morning. Good morning. The message out of Bank of America yesterday, it's dangerous to underestimate corporate America. That from Savita Subramaniam over at B of A after she upgraded her S&P 500 price target. Equity futures this morning just about positive by 0.1%. On the Nasdaq up by 0.1% also. Lisa, I think Savita wishing she took her own advice when she put that note out a number of months ago.
That's the sound of capitulating bears on Wall Street across the board. And this is the reason why people have been so reluctant to be bearish. It has been a slap in the face time and time again as this market continues to grind higher.
That's the equity story. Under surveillance this morning, more tariffs.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
So here's the latest this morning. President Donald Trump announcing a higher than expected 50% tariff on imports of copper. Joining us now out of London, Bloomberg's Brendan Murray. Brendan, welcome to the programme. Let's just start with strategy. What is the strategy here?
Well, the president sounds pretty frustrated that he's not getting the trade agreements by today, the previous deadline to do so. He's negotiating with several major U.S. trading partners, and really none of them have come to the table and signed on the dotted line. So what we're seeing the president do is take another track with these sectoral, these 232 tariffs. Copper and pharmaceuticals were the ones that he announced yesterday, and both of those have their own strategic role. Number one, the president is reminding trading partners that he has this other authority, this sectoral authority, to put tariffs not just on the raw material of copper, but the derivative products of copper, consumer goods that are made with copper. So it's just an alternative tool that he can use. The other issue with the pharmaceuticals is he's in the middle of discussing a trade agreement with India and the European Union at the moment, and they are big drug exporters to the U.S. So part of this is to turn up the dial, turn up the heat on these two economies, so he can get some of these deals over the finish line.
Brendan, on Wall Street, a lot of investors don't see these threats as credible. They don't believe the president will follow through. When you sit there in London and hear from trade partners negotiating with the White House, do they believe the president will actually follow through on August 1st?
I think there's a bit of growing understanding that this is the game that Donald Trump plays. That he threatens the worst, and if you wind up somewhere beneath that, then you feel like you've got a good deal. Just look at these reciprocal tariffs. He's threatening 50% on the European Union. They're probably going to come in somewhere around the base of 10. So, and they're going to, by all accounts that we have are reporting in Brussels, they're going to accept a 10% tariff on all European exports to the U.S. and they're going to have to just accept that. So I think it's basically at this stage a question of pain tolerance. How much can the U.S. trading partners take? And President Trump is saying, if I can't do it with these broad reciprocal tariffs, then I'm going to do it with this patchwork of sectoral ones.
Brendan Murray out of London. Brendan, thank you, sir, leading our trade coverage out of the City of London. Joining us now to talk about trade more broadly, Scott Lincicome of the Cato Institute joins us now for more. Scott, let's just pick up on this 50% copper tariff. We've got some great mines, copper mines here in the United States, in Utah, in Arizona. We've also got a massive deposit at Resolution, and we could have some real big production in this country, but it has nothing to do with getting prices up and everything to do with regulation. If they go forward with this 50% tariff on copper, what would happen to the economy?
Well, in the short term, given that about half of all of our all of our copper consumed in the United States imported, we should expect much higher prices and then downstream harms for companies that consume copper, whether it is in manufacturing or construction, utilities, and the rest. I mean, if you look at the steel and aluminum tariffs from 2018, 2019, that's exactly the playbook. You get a little boost in the upstream sector and a lot of pain in the downstream sector. Like you said, though, the big problem in mining and refining and copper and the rest is regulation. It's not the inability to produce. It's not foreign import competition. So it's hard to see how these tariffs do anything much other than impose pain for consuming companies.
Scott, when you look what the president is looking to do with copper at 50%, do you expect carve-outs?
Well, if this were 2018, 2019, I would say yes. The playbook for steel and aluminum back then was substantial carve-outs for entire countries for specific products. This time around, I wouldn't expect that. Look, steel and aluminum are now blanket tariffs at that rate. Very few carve-outs, as Brendan just mentioned, a significant expansion to downstream derivatives. Now about half of all imports covered by the 232s for steel and aluminum are derivatives. They're downstream products. And so for individuals hoping for big carve-outs, I'm not optimistic.
But doesn't this go against what the president wants to do in terms of a revamp to the U.S. manufacturing base? Isn't this going to make it so much harder, much more expensive?
Again, not to sound like a broken record, but you could say the exact same thing about steel and aluminum. When you apply high tariffs on upstream inputs, you can help upstream industries. You're going to harm a lot more production, output, jobs, investment in the downstream industries. Same thing's going to go for copper. If I were applying a reasonable approach to U.S. trade policy, I would say it doesn't make sense to do this if you're trying to boost manufacturing, particularly advanced manufacturing. But, I'm not in charge over there these days, and it does seem they're willing to take that downstream pain for these upstream production gains.
Scott, to John's point earlier, a lot of people and trading partners are taking this as a negotiating tactic and really taking it in stride, not necessarily viewing it as an absolute or the path of travel. Why do you say that the tariff wars are just starting? Why does this indicate to you that things are heating up rather than winding down?
Well, my base case is that the president really likes tariffs, and Congress has given him a wide range of laws to implement his tariff plans. And whether it is the Section 232s or the International Emergency Economic Powers Act, which gives you the fentanyl tariffs and the reciprocal tariffs. Remember, we still have Section 301 out there for the China tariffs and those shipbuilding fees. And the president seems intent to use all of these laws to implement his tariff plans. I do agree that there is a lot of bluster when it comes to things like 200% pharmaceutical tariffs. But I also think it's a given at this point, or it should be at least, that we are in for a much higher U.S. tariff regime through all of these different laws, historically high tariff levels in the United States of between 15 and 20% on average until Congress changes those laws, or maybe the courts act, which really doesn't seem likely outside of IEEPA.
So just putting this all together, Scott, it sounds like you think the markets and trading partners are overly complacent when they're looking through this in a way that's very different to April 2nd.
Yeah, I do. I think that there's too much optimism that we're going to see Taco Trump in all of this. But we always need to remember the United States is a massive and dynamic $30 trillion economy that depends mostly on services and has a lot of tailwinds with AI, deregulation, some on the tax front with the new full expensing provisions that just got implemented. So we could do a lot of damage and still have a decent economy. The way I describe it is I can cut off my pinky and not die. It doesn't mean that cutting off my pinky is a good idea, but it doesn't mean we're in for, a catastrophic economic consequences.
Don't do that, Scott. It's got to catch up. I want to see you again with all five, okay? Scott Lincicome there at the Cato Institute. Scott, thank you, sir. There's some natural tension between two goals. National security goals for primary materials like, say, steel, and boosting production downstream, boosting manufacturing. And there's some obvious tension between those two issues right now.
There's tension between those two issues, and there's tension between the desire to put tariffs on everything so you can get revenue that can offset some of the deficit increases. So you have this idea of what you want to generate on some sort of production basis and what you want to generate in terms of revenues that will help Washington, D.C.
Splitting the global copper market in two at the moment. Coming up on the program, Terry Wizman of Macquarie, with President Donald Trump defending King Dollar. Plus, Sucharita Anand with your morning movers as Meta makes a major investment in eyewear. The market moves are pretty tame at the moment, positive by 0.1% on the S&P 500 after dropping yesterday by a similar amount. Some tension between what the president's saying and what the market is hearing. The president is saying no extensions beyond August 1. The market's just hearing August 1 is just the new July 9th and we'll move on. Equities beyond the S&P 500 on the Nasdaq up by about 1/10, on the Russell up by about 1/10. In the bond market, 2-year, 10-year, 30-year sit on that 10-year maturity. Yields higher for 5 consecutive sessions into today. Yields just about unchanged this morning at 440. Later on this afternoon, some supply.
$39 billion of 10-year notes, and that comes ahead of tomorrow's $22 billion of 30-year notes at a time where even yesterday's 3-year note auction didn't go swimmingly. So it raises the question of how high the bar is for some of those foreign buyers and non-bank buyers to come in and say, we like that stuff, when people are calling it a risk asset.
And not a great time for it. I talked about that tension at the moment. The tension in the bond market worldwide, in the UK last week, in Japan over the last few days, stateside, just about unchanged in treasuries at the moment. With 3 hours until the opening bell, your cash open just around the corner with your morning movers. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with the maker of Ray-Bans, EssilorLuxottica. It's up 5.8% in the Paris trade on our reporting that Meta Platforms is taking their partnership to the next level as the tech giant pushes deeper into the smart glasses market. We're reporting that Meta took a nearly 3% stake in a deal worth about $3.5 billion. But these two companies have been working together for years and already have smart glasses on the market that can give you things like real-time stock updates, which I think could be very useful for these segments. But anyway, moving on to pharma, we have Merck and Verona. The FT is reporting that Merck is close to buying Verona Pharma, which makes respiratory drugs. As a result, Verona Pharma is up nearly 20%. The report says the deal would value Verona at about $10 billion, and an announcement could be made as soon as today. And we end with the power firm AES. Its shares are up nearly 15% now in the pre-market on our reporting that it is exploring a potential sale, and infrastructure giants like Brookfield and BlackRock are said to be interested. That's because its shares have lost about half their value in the past 2 years. But this is a company right in the center of the AI-driven energy demand frenzy, already supplying power to the likes of Microsoft and Amazon. So it is ripe for a takeover. John?
Yahara, thank you. Just to close the loop on that Merck Verona story, that deal is confirmed. Transaction value of about $10 billion. Merck to buy Verona Pharma. The deal expected to close in the 4th quarter. That just crossed just seconds ago. That's the latest on M&A. On our radar this morning, President Trump set to announce new developments on trade. The president saying the White House will release updates on at least 7 countries this morning, followed by more this afternoon.
So he says more letters are coming out. He also was talking about the fact that tariffs will start being paid on August 1st, and he continued to say there's been no change to this date. There will be no change. In other words, all money will be due, payable starting this date. No extensions will be granted. And the reason why the market is almost shrugging this off is because the president also said in all those letters he sent out that these tariffs can be maybe modified upward or downward depending on your relationship with our country. So which one is it? Which is why it feels like these deadlines are just open for debate.
Which raises the question of how much the markets and even the sort of sanguine approach that trading partners are taking to some of these tariffs is giving a green light to President Trump to go even harder, to go even more extreme, to have even more sensational headlines. And I do wonder at what point we're working ourselves up into sort of a perilous situation where people are taunting him to take it even further, because right now people aren't buying it. It just is an interesting dynamic at a time where even trading partners are like, yeah, we got a letter. Ooh, big deal.
Remember in the news conference when he was asked about Taco?
Yeah.
A lot of bulls heard that and said, don't do that.
Yeah.
Don't ask him about Taco. You're just pushing him. That's the feeling a lot of people have.
And that's kind of what you see. I mean, yesterday people were talking about, OK, we have a sense of what the range is of what tariffs might look like, and then 50% on copper. And it's this question of, OK, how high is the ceiling at this point? 200% potentially coming down the pike because trading partners are not coming to the table in the way that President Trump wants. You just wonder at what point he presses the button. At what point there is a repeat of some sort of April 2nd moment just to spite those types of rumors.
Annmarie mentioned this earlier in the week, the words, I think, of Lisanne Saunders, when she said maybe it's not a Trump put anymore, perhaps it's a Trump call. And with stocks very close to all-time highs, certainly in the minds of many, the president feels emboldened going into this trade story through the next few weeks. Take a listen to this. The president pushing forward with a 50% tariff on imports of copper into the United States. The announcement sending copper prices rolling over and injecting fresh uncertainties into global trade.
And we're seeing right now the price of copper traded in the U.S. trading at its highest level relative to that traded in Europe ever. That premium continues to widen. Why? It's not necessarily because people are believing these. It's that all producers and all consumers of that are just front-loading all purchases. And you have to believe that's what's happening across the board. We got 2 more months. All right, let's bring it in. Let's bring it in. So how much are we not going to see the pricing increases passed along for quite a while before we get a sense of exactly when those imports are going to be taxed in the way that they currently are being talked about?
If you're interested in copper production in the United States, Freeport and Rio have some great mines in this country, in Utah and Arizona. If you're interested in why we haven't been able to advance it, boost it even further, just Google Resolution Copper and see how long that's been tied up in courts. A joint effort between Rio and BHP. We could have massive production in this country. It's not about higher prices stimulating supply. That's not going to be the story here. If you want to boost production in America, you've got to do something about regulation and fast.
This is the reason why people are getting increasingly bullish. It's the regulatory story and the deregulatory push that people haven't accounted for, that they see as more realistic than some of these tariff numbers, 50%, 200%, 145%, 30%, that seem to be fungible on a day-to-day basis.
Let's turn to the US consumer just briefly. The latest on Amazon seeing a 14% drop in sales for the first hours of Prime Day compared to last year after extending the event to 4 days long. A number of sellers opting to sit out this year's event in the wake of the president's tariffs.
Is this because they are concerned about shopping? Is this because the deals they're being offered aren't as good as they have been in the past because a lot of companies don't want to discount their goods ahead of said tariffs? It's an interesting moment. It's also a 4-day Prime Day, so we might not be getting a real sort of day-to-day comp in the same way that the previous 2-day events have been held. But it really does raise a question, how good are the deals? Because I've looked, and they're not that great right now.
How much pre-tariff inventory is left at some of these retailers? I don't know.
How much do they want to move that inventory if potentially that is their last chance to get margins that actually make sense for them?
We'll have more on this story a little bit later. Let's turn to foreign exchange. President Trump saying he's prepared to punish countries that challenge the reserve currency status of the US dollar.
If we lost the world standard dollar, that would be like losing a war, a major world war. We would not be the same country any longer. You ever hear the expression, dollar is king? The dollar is king. We're going to keep it that way.
Joining us now to discuss, Terry Wizman of Macquarie. Terry, good morning.
Good morning, John.
Is the dollar still king?
No, the dollar is not still king. There's plenty of indications out there that there is de-dollarization taking place. It's happening slowly, and I think that's why maybe some traders don't pay too much attention to it or try to be in denial effectively. If it's not staring you in the face and it's a slow drip, why talk about it? But the slow drip continues. The reserve allocators are allocating less of their balances to the dollar. We're seeing banks in China, for example, that lend money to some of their emerging market clients, asking them to borrow in renminbi and not in dollars. The Federal Reserve did a study about this. We are seeing clearly a movement away from the dollar by private investors and semi-official investors, including pension funds, right? They want to effectively diversify. I think these are all aspects of a de-dollarization that's taking place slowly. I think the etiology of this, the origin of this, is the view that, first of all, the U.S. is disengaging from the rest of the world, and the Bretton Woods II arrangement, implicit as it may be, it no longer applies as strongly as it did prior to this administration. And of course, there's plenty of policy uncertainty. The idea that the U.S. is exceptional because we have something called ordered liberty, I think is breaking down. We may have managed chaos, but we certainly don't have ordered liberty anymore, and I think that's an aspect of the de-dollarization story as well, or at least the willingness on the part of many investors to look at the dollar differently and in a different light.
I think you just spoke about the US dollar for the best part of 2 or 3 minutes and didn't mention rates once. How divorced is this story from rate differentials?
It's never going to be completely separated from rate differentials, but I suspect that you have to separate the cyclical aspect of wanting to hold a dollar and the rate-based reasons for wanting to hold a dollar from the structural story. And it may be the case that and it may not matter, of course, because the Fed may be cutting rates, in which case it would give a kick to the de-dollarization story, to the lack of willingness to hold dollars. So we may get an amplification from the rate story in the next few months of the willingness on the part of investors to de-dollarize or move away from the dollar. But if the Fed were raising rates, yeah, to some extent it would be important in preserving the value of the dollar, but it's not going to stand in the way of that structural long-term trend.
Not to get too textualist, but what does de-dollarization mean? Does it mean not transacting in dollars? Does it mean hedging dollar risk, which is what a lot of people say is actually happening?
Yeah, it's more than one thing. In fact, I'd say it's maybe up to 5 things. When you look at what the Bank for International Settlements does, when they look at the use of the dollar, they look at it against, on 5 dimensions. They look at how much financing is taking place in dollars around the world by international borrowers, cross-border borrowers. They look at how much of international trade is denominated in dollars, is invoiced in dollars. They look at reserve managers. How much are they holding in dollars as a percentage of their reserves? So, and there's probably about 2 or 3 other qualifications or dimensions by which they look at that. Most of them have, again, been doing this slow drip for the last few years, right? There's been a somewhat slow decline. And I suspect that we're going to have other central banks around the world actually want to have more prominent use of their currencies. So this might amplify the story too, right? We have Christine Lagarde at the ECB saying that she wants to give more prominence to the euro in international transactions, in global trade. So, and she sees her window of opportunity just at a time when the U.S. is disengaging. So you might have not just a push from this administration, but you may have a pull from other central banks. And I think what the BRICS are saying is part of that pull as well.
Is this story overplayed, given the fact that the euro region isn't exactly a bastion of political calmness or sort of fiscal order right now?
Yeah, so it depends on this whole story of European integration, I suppose, right? If Europe can start to begin to look a little bit more like the U.S. did, say, a few years ago, where they are issuing bonds jointly, where they are promulgating regulation jointly and uniformly and coherently, where they adopt a common foreign policy. I mean, all of the things that might make the European Union look more like what we idealize the U.S. to be will help, I believe, the internationalization of the euro.
What will reverse this trend?
Well, I mean, let's go back to the origins of the problem, right? If you believe that policy uncertainty emitting from the U.S. is one of the reasons, well, we have to have a reversal of policy uncertainty. We have to move away from managed chaos and maybe back to ordered liberty.
Deals. You actually need to see real trade deals.
Well, I don't think so, actually. I think if all of this tariff situation were to go away, and I don't think it will because we're going to see another round of strategic tariffs, there's other reasons why there's policy uncertainty emanating from the U.S., right? Are we going to get our fiscal house in order, for one thing? Are we going to see the kind of fiscal tension, social tensions, rather, that we have seen in the last few years? I mean, I think all these things play a role into how foreign investors perceive the U.S.
And what about who's next to lead the Fed? Do you have any thoughts on both those Kevins and what their trajectory could mean for the dollar?
Well, I will say this. I don't want to intone on who I think might be the next chairman. I will say this. We're going to get some short-term indications potentially as soon as today, because we're going to see those minutes. And if there are only 2, and will remain unnamed, or I'll name them, it's Michelle Bowman and Chris Waller, who are advocating for lower rates, then they are going to clearly be in the running for next year. But if we see the cohort of Fed officials who are demanding a rate cut start to broaden a little bit, well, we might be able to put other people into the mix. Politically, I think that makes sense.
Terry Wizman of Macquarie. Terry,
my pleasure, John.
Thank you. Lots to think about. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. The EU is nearing a trade deal with the US. Sources telling us here at Bloomberg the preliminary agreement would include carve-outs for commercial aircrafts like Airbus and for car makers like BMW and Mercedes-Benz. The EU has until August 1st to clinch a preliminary trade deal. And the Supreme Court gave President Trump approval to cut the size of the federal government. The decision lifted a court order that had blocked federal departments and agencies from slashing their workforces. A coalition of federal employees, non-profits and local governments said the decision, quote, dealt a serious blow to our democracy. And Meta bought a minority stake in the world's largest eyewear manufacturer, EssilorLuxottica. Sources tell us here at Bloomberg that it bought just under 3%, or around $3.5 billion worth of the Ray-Ban maker. The move signals Meta's commitment to the fast-growing smart glasses industry. And that's your Bloomberg brief. John.
Lizzie, thank you. Appreciate it. More from Lizzie in the next hour, in about 30 minutes. Up next on the programme, calling for Powell's resignation.
He should resign immediately. We should get somebody in there that's going to lower interest rates. I think he's terrible. I think, look, we're paying, I call him too late. He's always late, but he wasn't late with Biden before the election.
Up next on the program, Andrew Sheets of Morgan Stanley, live from New York City. You're watching Bloomberg TV. Equities positive here by just 0.1% on the S&P 500. Under surveillance this morning, calling for Powell's resignation.
He should resign immediately. We should get somebody in there that's going to lower interest rates. Why don't you go for his resignation?
Do you want congressional Republicans to investigate and pursue?
Okay with me. I think he's terrible. I think, look, we're paying, I call him too late. He's always late, but he wasn't late with Biden before the election. He was cutting him like crazy. It didn't help too much, did it?
It's the latest this morning. President Donald Trump calling for Fed Chair Jay Powell's immediate resignation. The race to replace him said to be narrowing down to NEC Director Kevin Hassett and the former Fed Governor Kevin Walsh. The Wall Street Journal reporting Hassett met with Trump at least twice in June to discuss the role. Joining us now to discuss that and global markets, Andrew Sheets of Morgan Stanley joins us now for more. Andrew, good morning. You're the lucky one. You get this question, OK? Here's the menu. On the menu, equities, the long bond. Lisa wants to talk about that, the US dollar. What would happen if Kevin Hassett got the nomination from President Donald Trump?
Well, thanks. Good morning. It's great to be here. And look, it's hard to speculate on any specific, nominee or action. But I think if what we're talking about is the administration looking for a Fed that will run more dovish policy, all else equal, this is, I think, consistent with a weaker dollar. This is consistent with a steeper yield curve and higher term premiums. And, for equities might take that initially more positively. But I do think the key story here, and I think we're already seeing this. We're already seeing this in the weaker dollar. We're already seeing this in the steeper yield curve, is I think the market is already injecting more risk premium into certain U.S. assets, given longer-term uncertainty over Fed policy and also longer-term uncertainty over the U.S. fiscal path, which just got more complicated with the passage of the latest budget bill.
Lisa talked about this yesterday, this dynamic, and I think you're dead on. The president is telling you exactly what he wants. He wants a lot of issuance at the front end of the curve, and he wants the Federal Reserve to drop interest rates.
Essentially, this is a backdoor monetization of the fiscal deficit, because if you end up lowering rates to zero and then issuing at the front end, well, why not? At the same time, that could potentially boost inflation. Why are you bullish on long-duration credit, given that potential backdrop?
Sure. So, I think credit is the other side of this story, this large public sector deficit that we see, 8% of GDP, 7% of GDP, 8% of GDP. Well, it's a private sector surplus. The household balance sheet, the household net asset position is very good. The corporate balance sheets are in very good shape. Right. One of the reasons why that deficit is so large is we've cut corporate taxes, which is good for that corporate balance sheet, good for those corporate cash flows. So I do think investors could say, look, on the corporate side, you have more flexibility about where you're going to issue. You've got attractive yields. You've got, long duration IG in the U.S. at 6%. That's, that's probably, 400 basis points over inflation. 3.5% over inflation. That's an attractive real rate of return in a world where I'm less certain maybe about the long-term fiscal trajectory of the U.S., maybe a little bit less certain about the issuance pattern, and corporates are a good place to hide out.
Let's put corporates aside. Just do a thought exercise. If the Fed were to do that, if essentially there would be a backdoor monetization of the fiscal deficit, what would that do to inflation, given that it would probably weaken the dollar that much further? And this is not an insulated economy the way that some people are aiming to make it.
Well, look, I mean, if the premise is that, if the scenario you were talking about here is that the Fed's going to fundamentally run lower interest rate policy, easier policy than one thinks it theoretically should, that probably should absolutely mean higher inflation, all else equal. And Not only that, it should mean higher risk premium above that level of expected inflation. So it's a double whammy there. And I do think that that's consistent with a steeper curve. Our rate strategists do think that the TIPS break-even curve should steepen. So we see a steeper yield curve in nominals. We see a steeper break-even curve. That's not necessarily about any expectation that the Fed cuts to zero. We think they cut to 2 5/8 by the end of 2026. But this idea that more risk premium will get injected into the long end of the curve, I think, is very consistent with how we're seeing things.
2 5/8 by year-end 26. When do the cuts begin?
So we think they happen kind of around the first quarter. So we don't think there's any cuts this year. And this will make it maybe a little bit awkward with the Federal Reserve and the administration. But what we think will happen is that you're going to see inflation pick back up. You're going to see core PCE at the end of this month, at the end of August, at the end of September, start to reflect some of these tariff effects that we know or that we think are in the data and are coming in. At the same time, given lower immigration in the U.S., we think kind of break-even job growth in the U.S. is a non-farm payroll number below 100,000. So we think for the Fed, which is doing much better on the jobs mandate than the price stability side of its mandate, if inflation's picking back up, if payroll growth is in line with steady unemployment, they should be on hold, we think. And that will keep them on hold for longer, and then they'll cut later and probably more in 2026 as growth continues to slow.
But Andrew, inflation has been coming down, and we still have tariffs. So why do you think it's going to pick up in July?
So I think this is where this month's number is so interesting, because on our forecast, on Morgan Stanley's forecast, the number we got at the end of June was the last good number for a little while. And now we think it's starting to pick up. And I think what's interesting is that in those categories of inflation that we think should be most tariff impacted, we've seen some of the least impact on prices, which we think is more of a function of a delay in the data. It's a function of how retailers might be selling off inventory acquired at old, better prices. But we think that is coming. And so if you add that with also, further tightening of the labor market, again, lower immigration, that's a tightening negative supply shock in our view. We think that the core PCE number at the end of July, at the end of August, at the end of September, that picks back up, and then we'll start to see this. This is a huge debate, though, but that's what we expect.
So if the data for this Fed shows that they cannot cut, and this is going to be potentially, as you say, awkward with the administration, do you think there's more of a chance Trump leans into putting in a shadow Fed chair?
I think that's difficult because, again, I think talking in those hypotheticals, talking in the theoretical is always challenging. I think this idea that in a scenario where the Fed is on hold as we expect, as growth is slowing, as I think the administration has made it very clear that it thinks monetary policy should be easier, I think assuming that there would be more friction, more criticism of the administration towards the Fed is probably a reasonable assumption to make. And again, I think this is maybe part of the case why those risk premiums further out the curve should be higher. The market thinking, well, maybe this will drive a larger shift in the next Fed chair's philosophy or who is picked, given the greater attention he potentially get this year.
Andrew Sheets of Morgan Stanley. Andrew, a clinic. Thank you, sir. Andrew Sheets of Morgan Stanley and the team at Morgan Stanley, Mike Gapin, of course, expecting no rate cuts in 2025.
Which amps up potentially the tension. I'm just thinking through, if you get somebody in who really is going to cut rates to 1%, 2%, how much you see a massive blowout in terms of long-term rates, what this does to the mortgage market, whether this completely restructures what people demand even on the front end. Because if you know that the U.S. government has to finance its entirety on the front end, why not charge 5%? Hold it all in T-bills and call it a day.
It's great to have Bramo Bear back. You went missing for a little while.
She hibernated for a little
I
bit.
mean, honestly, it's hard to get bearish when everybody's so bearish it doesn't ever come to fruition.
But now they're bullish again.
But now they're bullish again.
Yes. Coming up on the programme, John Boivin of BlackRock, Ed Mills of Raymond James, Jay Bryson of Wells Fargo, the former senior White House trade advisor, Kellyanne Shaw. The second hour of Bloomberg Surveillance, up next.
Is becoming more difficult to get extremely bullish on the index at these levels.
There's a very, very decent chance that we actually do squeeze, and we do squeeze a lot higher.
The long view is still quite optimistic.
There's broad participation in the market, but the magnitude of the upside is just in a handful of names.
The market has been going higher, and it will take a meaningful shock, I think, to disrupt that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P just about positive by 1/10%. On the benchmark stateside, following 2 days of very mild losses on the S&P 500. Your day ahead is shaping up as follows. Later on this afternoon, some Fed minutes. An important one, though, an auction at 1 p.m. Eastern Time of 10-year bonds.
$39 billion of those longer duration U.S. Treasuries at a time where there's a real question about what this asset looks like going forward, a real question about U.S. exceptionalism and what this government would like to do with the deficit if you're going to be issuing more on the front end, short-term debt, and maybe phasing out the long-term debt at the same time that you've got a Fed chair, potentially a new Fed chair, that wants to cut rates significantly.
Let's talk about that new Fed chair. The Wall Street Journal out with the report overnight, narrowing it down to two names, the two Kevins.
Kevin Hassett and Kevin Warsh. So Kevin Warsh was an individual that really rose to prominence within Trump orbit when potentially he was going to be the Treasury Secretary. And the reporting on the Wall Street Journal is that he's set to go down at some point, have this meeting with Scott Bessent. Then there's Kevin Hassett, who is the president's current NEC director. And what's interesting about him is the Wall Street Journal says he already has had 2 interviews with the president, specifically talking about the Fed chair position. And then you can see the change of tone, even this entire summer we've had so far, from Kevin Hassett, who used to say things like, it is my job as the NEC director to make sure that the Fed is treated independently, to basically saying Jay Powell is a Democratic puppet and he listens to Elizabeth Warren. His tone has changed since his name has entered the ring.
Just because you believe the Federal Reserve should lower interest rates, I don't think implies that you're political bias. There is some credible arguments out there for lower interest rates. What will matter is perception, how the market will perceive the nomination. That's really important here. And as we've said a few times on this program over the past few weeks, the market will get a vote long before the Senate does when the president picks a name.
And to your point, this is a nuanced debate. This isn't about cutting rates or not cutting rates. This is about how much you cut rates and in response to what kind of economic data. Right now, we're looking at a market that's pricing in about a 65% chance of a September rate cut. That's baked in as more than a 50-50 chance. You have at least 2 or even 3 rate cuts priced in by a lot of different shops around Wall Street. So it raises the question, what would be fiscally irresponsible? What would be irresponsible from a monetary policy point of view? And that ultimately lies with the inflation data. If inflation is not coming down and you still see a Fed chair that is getting jawboned into lowering rates in a significant way, watch out for the fireworks.
CPI, July 15th, a week yesterday. Look out for that next week alongside earnings as well. This equity market at the moment, though, taking everything in its stride. The president promising more tariffs and saying there will be no extensions. And equity futures are positive by 1/10%. And yesterday we were down by what? 1/10%. Coming up on this hour, we'll catch up with Jean Boivin of BlackRock and why he's staying overweight U.S. equities. Ed Mills of Raymond James as the White House rules out further extensions. And we'll catch up with the former senior Trump trade advisor, Kellyanne Shaw. We begin this out with stock steady as investors digest President Trump's latest trade threats. Jean Boivin of BlackRock writing, we now see even more cause to stay risk on and overweight U.S. stocks. Jean joins us now for more. Jean, good morning.
Good morning.
Just explain yourself, sir. Why?
I mean, it boils down at the end of the day, huge amount of uncertainty. Of course, we've been going through that this year. We don't think there's much insight in saying that anymore. It's really about how you get a handle on this. And I guess our strong conviction is that, when you look over the near term, we have more certainty about the outlook than we would have over the next few years. That's a very unusual environment we are in right now. And over the near term, the world cannot change very quickly. So there'll be, noise, there'll be headlines, there'll be attempt to do stuff. But there are immutable laws at play, and that's going to shape the outcome. So we tend to, overall be, pro-U.S. assets, and at the same time, try to fade the extremes that you're going to see coming both ways, actually.
There is a distinction, though, when you say overall be pro-U.S. assets between stocks and bonds.
Yes.
What is the difference?
Well, the difference is that, we like equities and bonds, I think, are are more tricky in this environment. And so U.S. equities, we think there's like powerful mega forces that are at play. AI is a big theme. We continue to believe in that. That supersedes, I guess, the near-term trade noise and so on. But when it comes to the bond and fixed income, but government bonds in particular, well, we have a lot of things at play that are, for us, pointing towards higher yields, higher long-term yields, term premium that needs to reappear. And so we remain underweight, U.S. Treasuries as a result.
Is this a U.S. story or is this a global story at a time when I believe that you prefer European bonds, even though they're still issuing a lot of debt and facing some of the same kinds of issues?
It is a U.S. story to the extent that we think that's where the repricing is the more serious. It's also related to the greater uncertainty we have around the Fed outlook, the inflation outlook, the debt picture. Whereas in Europe, I mean, inflation is on the way down. You can tell a very credible story for why inflation will surprise on the downside. The ECB has more room to cut even from here. So that leads to, more support for European bonds.
So overweight U.S. equities, underweight U.S. government bonds, while you're overweight European government bonds, maybe underweight European equities. I'm just wondering if you could give us a sense of the last time, just to sort of frame this out, that you were less exposed to U.S. Treasuries, particularly on the longer duration versus European ones. When was the last time you had this dynamic in BlackRock's portfolio?
Well, we've been, for the last few years, constantly underweight U.S. Treasuries. So we've been of the view that inflation was a structural phenomenon in this environment, that rates will need to adjust. There's a fiscal story that is not the new thing of this year. There's been a deficit story post-pandemic that was putting pressure on yields. So that story has been with us for a few years now. That has been one of the strongest convictions we've been having throughout that time. And there's been new layers now added to this, which it's unusual to say we've been structurally underweight U.S. Treasuries for so long, right? You would have been tactically moving around that, but that's really like a lasting story for us.
When it comes to these new layers, you're probably mentioning, at least thinking about the one big beautiful bill. Why didn't we see more pushback from the bond market?
Well, I think there is a lot of structural demand still for U.S. Treasuries. So the reason why we're underweight is not a bigger sensational story around U.S. exceptionalism being questioned, or it's not about U.S. Treasuries not playing their safe asset role as much as they had in the past. So we're not questioning the fundamental structure of the. And there's going to be a need, a structural demand for this. So I think the markets are adjusting. There's no panic so far, but it's on the drifting up. I think there's room for digesting some of the big beautiful bill that came through, and then there's a lot of question now on how it's going to come next. And so I think it's going to be up. Yields are going to go up. It's going to be absorbed over time towards with higher yields.
You're saying this at a time when the president's talking about sending out more letters where tariff rates look very similar to what happened on Liberation Day. Do you think Trump has primed the market to basically absorb his aggressive policies?
Well, I don't know if the president has primed the market in any way, but I think we have more conviction ourselves since April 2nd and April 9th that what I talked about before, the immutable laws cannot change quickly in the near term. And one part of it is the bond market, to actually connect to the previous discussion. The U.S. relies on foreign funding for that debt that we're talking about. That's maybe something that we would wish to be different, but that's the starting point. That cannot change overnight. And I think that's going to limit the maximalist approach that you can expect to see. And we've seen that on April 9th. To us, it was the bond market that really provided the discipline at that point. And we've seen it, so I guess that gives us more conviction that going forward, that's going to still be a constraint for the time being, at least.
That's an interesting thing to think about. Do you still believe that any potential sell-off in Treasuries will be self-limiting because of that very fact?
I think so. I don't think the U.S. can sustain a massively higher yield. Even though we are underweight and we think yields are going to go up, it has to happen in a fairly gradual manner. And if there's any sign that this is like a very quick resetting, and we're in a world where we have 5% 10-year yield quickly on a sustained basis, the whole budget arithmetic that is already pretty challenged, I think, is out of the window.
So 5% is like a ceiling for you on a 10-year?
Well, I think if we're sustainably in a 5% world, I think that changes the picture quite a bit. I don't think it's a ceiling. I mean, will depend on other what the growth outlook is and so on. So I don't think there's a hard ceiling, but it's a different world if we are like adjusting to 5% sustainable.
Well, can I ask you then, why is it so different, given it's only 60 basis points away? Why is 60 basis points so important?
I think it's not so much the 60 basis points, but like this is now the kind of the norm, 5% that we expect to see over the next few years. That is a different world than we had 4.4. It might bounce back and up. So that's more a sustained aspect.
You and the team have been pretty consistent about this now for a number of years. At a time when a lot of people have started to price in rate cuts, back away, then price them in again. You've been very consistent about this. There are structural reasons to expect inflation to remain higher, and you think bond yields remain elevated. How convinced are clients of that story right now when you tell it?
Well, I think I find this, we're very convinced about this story, and I think there's different views out there, but I think it's less now. We have less pushback than we would have had maybe when we started to hold that view in 2022 and so on. So I think this has become in some ways more consensus. So less pushback, I guess, in that sense. But yeah, no, I think that's not an easy, hard sell, I guess.
John, appreciate your time. As
Thank
always,
you so much.
Jean Boivin there of BlackRock, looking for limited rate cuts from this Federal Reserve, if any at all, in line with what we heard from Morgan Stanley about 15 minutes ago.
With inflation really pressuring them to hold off on those said rate cuts at a time when Europe can potentially cut rates more significantly. Just picking up, though, on the self-limiting factor. I think that's important. This idea of if you start to see some sort of freak out, for lack of better words, in the long-term bond market, does that curtail some of the behavior to limit some of the more extreme scenarios that I was portraying about 5 minutes ago?
No big freak out, Abramowicz, in the bond market right now. The 10-year at the moment about 440. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump has vowed to push forward with his aggressive tariff regime, stressing his August deadline is final and he'll not be adding additional extensions on country-specific levies. Instead, hardening his tariff threats on copper and pharmaceuticals. And investigations are underway in the deadly Texas flash flood. They're looking into when weather forecasters advised local officials about flooding and what those officials did to spread the message to the thousands in the area. The floods killed over 100 people and 161 remain missing. And a leadership shake-up at Apple. COO Jeff Williams is retiring from his post later this year with plans to continue to oversee the design team and manage health initiatives. 30-year Apple veteran Sabi Khan will replace Williams as COO. And that should be my brief, John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. That stock is not in a good place. Apple's still down on the year by 16%. Up next on the programme, no extensions.
What incentives do countries have to negotiate? It seems that deadline keeps moving.
We didn't move, no. It's always been August 1st. August 1st they pay.
Up next, Ed Mills of Raymond James, live from New York City this morning. Good morning. Equity futures positive by 0.2%. This market's getting comfortable. Investors getting comfortable with all these tariff threats. I mentioned Bank of America. Dangerous to underestimate corporate America. Steve Chevron over at Federated. The market will get comfortable with new levels. And Goldman's David Kostin. We expect the digestion of tariffs to be a gradual process. We are looking through the risk going into August 1. Under surveillance this morning, no extensions.
What incentives do countries have to negotiate? It seems that deadline keeps moving.
We didn't move, no. It's always been August 1st. August 1st they pay. And everybody pays. Everybody has to pay. And the incentive is that they have the right to deal in the United States. If they don't want to, they don't have to pay and they don't have to deal here. But if they want to buy and make a lot of money and sell in the United States, they have to do that.
It's the latest this morning. President Donald Trump vowing not to extend his trade deadline beyond August 1. The president saying he plans to release trade updates for at least 7 countries later on this morning. Bloomberg's Tyler Kendall joins us now for more. Do we know who the 7 are, Tyler?
Yeah, hey, John. No, not at the moment, though we have gotten some indications on which countries could be gearing up to get a letter. On one hand, we know that those countries that President Trump has grown frustrated with were prioritized for letters, like how we saw Japan and South Korea get letters the other day. Perhaps that could indicate that some of those other trading partners, like India, for example, that President Trump keeps highlighting, could be in the mix. But he did give us at least one really firm answer, which is that the European Union could be getting a letter in the coming days. That's considered to be kind of surprising, since the European Union has been making progress towards a deal, with people familiar telling Bloomberg News that they are nearing an technical agreement in principle, with negotiators really focusing on getting carve-outs when it comes to the sector-specific tariffs. And that is why this new threat, particularly around pharmaceuticals and copper, is only going to complicate these negotiations for our trading partners going forward here. Because while we knew that the administration had launched these Section 232 investigations on the basis of national security concerns, the original intent was that they weren't supposed to be negotiated. They were supposed to have that more durable basis here for the administration. But now they've really come into the conversation in a meaningful way. John, when it comes to those copper-specific tariffs in particular, while we didn't know the date or the rate, 50% is considered to be, of course, pretty high. While it is in line with the steel and aluminum tariffs, it is higher than the original baseline we were expecting for sector-specific tariffs at 25%, which is only going to make those carve-outs that much more important.
Tyler, thank you. Tyler Kendall down in Washington. With us here in New York, Ed Mills of Raymond James. Ed, good morning.
Morning.
It is July 9th, and we have limited clarity. How much additional clarity will we have on August 1?
We'll have more clarity. I don't think we'll have a lot of the details. I think the whole goal this year is to get as many MOUs signed as possible, because I think what President Trump really wants to do is say, I got a trade deal with 112 countries. They're going to buy trillions of dollars worth of goods, even more trillions of dollars worth of market access, and we're going to work out all the details later. And I think that one of the good things about having this little extra time is what you need to do to get one of those MOUs is not all that complex. If you can work it out later, that's fine. And that's where I think the market is okay. As long as we have this extra time, sign the deal. And when you look at the letters that are going out, the new rates are not that much worse, or sometimes even a little bit better than April 2nd. So we're okay.
The new rates are basically April 2nd. It's basically Liberation Day Part 2. But in this letter, Trump does say that perhaps you could consider adjustment to this letter if you decide to come to the table. We may reconsider. But then yesterday he said, it's August 1st. These are the rates. We're not going to be adjusting. Which Trump do you believe?
The next Trump. I mean, it's like there is the only constant here is change. I mean, so I don't necessarily think that August 1st is necessarily a hard and true date. I don't necessarily think these rates are hard and true. I do think that there is going to be three buckets here. Bucket number one, new revenue. We have a huge new tax bill that is costing trillions of dollars, the most expensive bill in the history of the country. He needs that revenue. Bucket number two, protect national security. Those are the sectoral tariffs. If we are at war with China, what do we need to make here in the United States? And bucket number three has always been, can we use the force of the U.S. economy to force policy change elsewhere? That piece is always going to be the hardest part, and that's what all of these negotiations are about, Annmarie.
So who gets a deal today or tomorrow? I'm thinking of three in particular. Japan was supposed to, but they got the same second rate. India, I was getting tons of text messages yesterday saying it was imminent. I still see no language on it. And the European Union, which seems to capitulate on a 10% across-the-board tariff.
Yeah, I think the most likely is India, then Japan, and I think the least likely is the EU. I think one of the issues with the EU is the United States is asking Europe to make a decision. Are you with the United States or are you with China? And there are competing interests. You look at certain countries, and they're like, absolutely the United States. A lot of that economy is tied to us. Others have more exports going into China. Because they are a bloc with disparate interest, I think that's going to be very hard to get anything on the tape by April 1st. But I do think that Japan, India, Australia, a large part of the GDP globally can get a deal by August 1st.
Don't want to get into psychoanalysis here. What is it, though, about letters? Because it's always a letter. Why does everybody get a letter? And what is the importance of this versus just a verbal warning, maybe a presidential tweet? You know, what is it about a physical letter getting sent out that it has some import for President Trump?
Yeah, I think it shows action. I think it shows the kind of the ability to kind of flesh it out a little bit more. These letters, if you read them, they're basically the same, and they are very clearly dictated exactly by him and probably edited by him, because it's like you see Trump's voice in these letters. I do think that there has been a concern by President Trump that the taco trade is out there and that he always caves. So he wants to show and project this strength that if you don't come to the table, this is what you get. I think the biggest questions from the social media posts in these letters are some of the details. What does it mean that you'll have higher tariffs if there's transshipment? We do not have a structure in place to deal with kind of how that country of origin would be different. That's why I think the details here are going to take a long time. But he wants to say, here are the general parameters. This is what I want. You come to the table, you tell me what you're going to give me.
I'm taking notes, parenting notes, because I plan on sending letters to the household, and we do have a complaint box already. I am wondering going forward whether the reaction or non-reaction that we're seeing in markets is sort of emboldening him to send some more letters and to raise those rates up even higher.
Yeah, I think that's one of the big questions from clients yesterday at Raymond James is that after April 2nd, what got him to pause these on April 9th was the market reaction. And we've had these conversations so many times. What caused Congress in the past to raise the debt limit is the market reaction. And so are you in this dangerous place that if there is no market reaction, then you can get even more aggressive? And at what point is a mistake made? I don't think we're close to that, but I do think there's always a threat that if you need the market to correct and you don't get it, then you get more bold. The biggest change I've seen so far in this market is early on in administrations, they mostly focus on process. Later on, they focus on outcomes. Right now, this is a market that is saying, all right, the process might be changing, but the outcome is not likely to change. The only way we get a market reaction if they think the outcome is actually going to be materially worse than what they actually expected.
What would a mistake be? How do you characterize that?
Yeah, I think a mistake would be actually going to 50% with the EU and that sticking on for a period of time. When I was in Europe 2 weeks ago speaking with investors at Raymond James, there is a real concern about the weakness of the dollar and exports getting more expensive coming from Europe into the United States. And then you have tariffs on top of that. That could be a recession. Does that kind of have unintended consequences? We talk about, looking at yields here in the United States. We saw after April 2nd, the 30-year go above 5%. Does the 30-year kind of in the 10-year start spiking as we start issuing debt over the next couple months to refill the Treasury general account? And does he put pressure on the Fed to bail that out? And then there is a bond market reaction. Those are the things that I think are the biggest debates for the second half of this year is kind of the rate path.
That last point, the Federal Reserve. What are you telling clients about the Fed race?
So I think that I know that there is news out this morning that Hassert and Warsh are considered to be the front runners. I'd put Waller and Bessent into that camp as well. I think Donald Trump loves people to compete for the job. What I'm watching to see is, does Michael Barr step down as one of the Fed governors now that he's no longer vice chair for supervision? If he does, Hassert or Warsh is probably going to get that seat. Kugler, another governor, her term expires in January. That is probably the second seat. And then all four compete to see who can be the Fed chair come the May expiration of Powell's seat, and who is going to be the most dovish, who's going to be the most supportive of his agenda, gets it. It's a perfect scenario for Trump to have another game of apprentice, but this time for Fed chair.
Or Game of Thrones, equally as brutal. That situation, some names are more credible than others. Let's put it that way.
Yeah, or Bachelor. I mean, who gets a rose, right? I mean, we could put this on a whole host of different shows. This does raise a question, though, about how much the market's going to be voting, to your point. Who they're going to vote off the island. Love Island, maybe another one.
Yesterday, when the president was once again saying that Jay Powell is terrible, he then looked over to Scott Bessent and said, I like you better. And that made me think, maybe Bessent is back in this race and it's not just the Kevins.
Can you imagine these guys on Love Island?
I was just going to say, this is like
you
toxicity.
mentioned it. I don't know where you're going.
I mean, it just feels, like, playing for the love, and you only get love if you say what I want, and that's sort of a toxic relationship.
And then you watched Love Island.
Want to know more about the complaint box? Save that for another time.
It's true. It comes out once a week.
Okay. Ed Mills and Raymond James. Ed, thank you, sir.
Thank you.
Appreciate it. Up next, Jay Bryson of Wells Fargo on the health of the US consumer, plus Yahara Anand with your morning movers. And again, a thanks to Trump's levy on copper. live from New York City. Welcome to the program. 2 days of losses on the S&P, a small morning of gains so far. We're positive by about 0.2% on the S&P 500. On the Nasdaq, we're up by 0.16. It has been a snooze in the last 24 hours. In the bond market, check this out. 10-year Treasury. That maturity yields higher for a sixth consecutive session. The grind continues, up another basis point to 440.72. The debate at the long end of the curve, whether inflation will firm up in the coming months and prevent this Federal Reserve from reducing interest rates. But for this Federal Reserve, it's not just about credible economic arguments, it's about the politics of the moment. The president's saying we should get somebody in there that's going to lower interest rates. What does the former Fed Governor Kevin Warsh say? Tariffs are not inflationary. That's the argument at the moment if you want this seat at the Federal Reserve.
So we have Waller, we've got potentially Hassett, we've got Kevin Warsh, we have Scott Bessent. Real question is, how much does the market absorb the potential for rate cuts without freaking out? And the freak out being 10-year yield spiking higher. And that ultimately will be the true test of someone who can credibly be Fed chair, who could actually be pleasing to the president.
A big debate ahead of a 10-year auction later on this afternoon. $39 billion in 10-year notes. We'll come back to that later. 2 hours away from the cash open. Let's get you some morning movers. Here's Yohara Anand with more. Hey, Yohara.
Hi, John. We start with Freeport-McMoRan. Shares of the American mining giant are up nearly 2% after President Trump called for 50% tariffs on copper imports. So obviously, as the largest copper producer in the U.S., Freeport stands to benefit from this, since those tariffs will make foreign copper more expensive. And a little fun fact for you, the Morenci mine in my home state of Arizona is the largest copper mine in the U.S., and it is operated by Freeport. Next up, we have AES. We mentioned this stock earlier, but worth mentioning again because it is up nearly about 14.5% on our reporting that it is exploring a potential sale. And apparently, the likes of BlackRock and Brookfield are interested. That's because its shares have lost about half their value in the past 2 years. But this is a company right in the middle of that AI energy demand frenzy, and it's already supplying power to the likes of Microsoft and Amazon. And we end with another energy company, and that is Bloom Energy, rising 7.6% after JPMorgan upgraded the stock to overweight and nearly doubled its price target to $33. They're saying revenue at the company could get a boost after fuel cells qualified again for federal tax credits under the tax and spending law. That was not expected, but it is a big win for Bloom. John?
Yohara, thank you. More from Yohara in the next hour. On our radar this morning, President Trump expected to issue more tariff letters today as he vows not to extend his new deadline of August 1st. The president saying he plans to release trade updates for at least 7 countries this morning.
And how credibly will that be taken, given the fact that the market has shrugged pretty much everything off? The prospect of the EU being one of them is pretty shocking, given the fact that we thought that they were somewhat close to some sort of deal. And it raises the question, how badly are some of these negotiations actually going, that he's finding the need to really ratchet up the pressure?
Well, the EU is just hoping to get some sort of framework in place by today, then have the rest of the month to negotiate this agreement. The president, though, yesterday saying there's no change to this date when it comes to August 1st, and there will be no change to this date. At the same time, his letters leave open this possibility that if you come to the table with something he wants, he's willing to change the parameters of the deal, the negotiation. So the market's basically saying, we think this is all open for debate, at minimum, till August 1st.
We've said 2 things on this programme. The reason this has been somewhat disappointing to markets, I stress somewhat, is that July 9th today was meant to be a clearing event. It's not going to be. Going to have to wait till August 1. And based on the threshold the Federal Reserve set for itself, this is going to make it harder and harder for the Federal Reserve to cut interest rates, which makes this race to replace Fed Chair Jay Powell all the more interested. And it's said to be narrowing down to just 2 names now, the NEC Director Kevin Hassett and the former Fed Governor Kevin Warsh. The Wall Street Journal reporting that Hassett met with Trump at least twice in the month of June to discuss the role.
What do you think these conversations sound like? How dovish are you going to be? How many times are you going to cut? I mean, essentially, what are the parameters for President Trump to pick a favorite among what we believe to be the 4 major candidates, although, of course, there could be more, if there is this check by the markets? And I think there is a bigger question, which is, will the administration be beholden to a bond market that is concerned about some sort of monetization of the debt by issuing a greater amount of the debt in the front end of the yield curve, and then having a Fed that lowers rates as much as possible to reduce interest expenses That's going to be a key question for the long end and for the dollar.
What they talk about inside these meetings is probably what Kevin Hassett is willing to say now publicly. As these meetings were going on towards the end of June, this is what he had to say in an interview. Jay Powell's the person who cut rates right ahead of the election to help Kamala Harris and is, quote, doing whatever it is that Elizabeth Warren wants. That is what he is saying publicly, so you can only imagine what he is saying to his boss if potentially this is the job he wants.
I wouldn't usually be first in line to defend Senator Warren and some of her policies, but Senator Warren's been sending letters to Chairman Powell asking for lower interest rates, hasn't she?
She has been. They're on the same page. Yeah. The letters. I think I'm going to start writing letters. I'm just going to hold them up for surveillance. It'll be like the surveillance letter every morning. I just want to think we should do that.
Motivations matter, not just letters. And how those motivations are perceived matter a whole lot more to this market. You can have a credible argument to lower interest rates. We've heard it from Neil Dutta of Renmac. I find Governor Waller's speeches particularly compelling. They are credible. His view, his argument, why we should look through tariffs, look through any potential inflation shock and insulate the labour market. But if you believe that the decision to cut interest rates is not because of a credible economic argument, it's because the president asked you to, that's going to have a very different outcome in financial markets.
The key question is going to be, does the inflation data allow the Federal Reserve to cut interest rates or the labor market if it weakens substantially? Or are you going to get more jawboning about the expense of all of the debt for the United States? If that continues to be one of the motivating features, watch out for that long end.
Protecting Fed independence should make it easier to cut.
Correct.
If you undo it, it makes it harder, because the market will start to question a whole host of things. OK, we'll come back to the Fed a little bit later. Dan Ives of Wedbush, he's in focus, criticising the Tesla CEO, Elon Musk, and his move to create a new political party.
This is a time now for Musk. He needs to choose, and you can't keep having these one step forward, two steps back. I think there's a line in the sand that he's now starting to cross. I believe you've now hit a point. I think the board's going to have to get involved.
Dan, these are not my words. They are the words of Elon Musk, pushing back and telling Dan Ives, quote, to shut up on X.
My favorite part of this is actually, if you look right under Elon Musk's tweet to Dan Ives, you have someone asking Grok thoughts. Grok, of course, being the generative AI chatbot from
They all
XAI.
do. Isn't that just like a feature of X now?
But this is perfect. But do you want to know what Grok actually said? It sounds a lot like what Elon Musk would say, which I think is fascinating.
It is his.
Well, Dan's got some bold ideas. But capping Elon's time in politics, that's like telling a rocket not to launch. Musk's shut up sums it up. Tesla thrives on his chaos. As Grok, I'd say let the mad genius cook. I'll just say it sounds a lot like Elon Musk.
Well, the thing is that Ives is one of the most bullish on Tesla, and Elon Musk is telling the biggest bull on the street for his own company to shut up. Because why? Dan continuously says that he wants Elon Musk at the C-suite, not on X, talking about political endeavors, talking about starting third parties in the United States, and wants him focused on things like autonomy, where he thinks that's why you can get to a $500 price tag on the stock.
To your point, he has got a $500 price target on Tesla. Let's turn to the consumer. Amazon Prime Day getting off to a slow start. Data from Momentum Commerce showing sales falling almost 14% in the first 4 hours of the event compared to last year. Jay Bryson of Wells Fargo writing the following. Indicators of domestic spending, including real PCE and orders for capital goods, have softened. Jay joins us now for more. Jay, welcome to the programme, sir. Let's go with the first question. Do you believe the pull forward in the previous few months is starting to reverse? And are we starting to see some evidence of that?
Oh, yeah, John, we definitely are starting to see some evidence of that. I mean, you know, we're only 4 hours into Prime Day here. We'll see how all that shakes out. But, you know, if you look at recent spending indicators, they have all softened here in the second quarter. I guess the big question here is it just, you know, a reversal of that pull forward, something that will snap back later on this summer, or is this the start of a real trend? Our guess is it's the start of a real trend in terms of softer consumer spending data. You know, we're going to be looking at higher inflation in coming months. That will erode purchasing power. And so we're looking at some softer data, not negative consumer data, but just soft consumer data as we go forward.
How much, Jay, are we seeing companies that don't really want to reduce prices? They don't want to give massive deals ahead of potential margin compression in the face of tariffs. At the same time, the consumers are just buying less. So prices staying high, but people being less active, sort of the stagflationary-like scenario that some people have pointed to.
Yeah, I mean, we're kind of in that, that scenario right now, Lisa, in terms of just there's a lot of uncertainty out there in terms of the effects of tariffs. I mean, the good thing, I guess, from the company standpoint is they brought a lot of inventory in the first quarter. They got underneath the tariffs. They have this inventory that they can sell right now at lower prices. The big question is, as we go forward, is does that start to reverse? And our guess is you're going to see that in the numbers that are coming up, the June numbers for CPI next week. You'll see some higher goods prices. You're starting to see that starting to trickle in. And so, the inventories can't last forever. And sooner or later, if these tariffs do stick, you're going to see higher prices as you go forward.
This is kind of an in-the-weeds question, Jay, but do we have a sense of how long the inventories are going to last? Do you really think that we will start to see some of that pressure in next week's CPI report? Or could it be that people have stockpiled so much that we're not going to see it until much later this year, which will keep us in this sort of guessing game of will it or won't it really affect inflation rates?
Yeah, the answer to your question is it's kind of unknown. Our sense here is that you are going to start to see it in terms of trickling in terms of in the June numbers that we get next week, and then we'll start to see it over the next few months as well. I mean, I think it's a few month sort of phenomenon rather than between now and the end of the year. We think it's going to show up between now and let's say sometime in the early fourth quarter when we see the biggest impact of that reversing.
Jay, what do you think is going to have the biggest bite on the U.S. economy, the sectoral tariffs or the country-specific ones?
Well, I think it's more the across the board sort of rather than the sectoral ones. You think about the sectoral ones, a lot of those things are on steel and aluminum, things like that, things that consumers don't buy just directly. And so it gets passed on through businesses, and whether it all gets passed on completely, is a difficult question. But it's more of the across the board things, the things that can affect consumer prices directly, I think is probably the bigger effect on the price level and on the economy.
Jay, there is always something to worry about. In my experience living here in America for the 10th year, there's always something to worry about, and the economy turns out to be okay. Your experience goes beyond my 10 years. It goes back decades to the University of Alabama when you were assistant professor. Now wrapping up your career at Wells Fargo. There's a reason I'm doing this, of course, because this is your last appearance in your seat before you retire, sir. Could you share some wisdom with us this morning? What's your biggest lesson of covering this economy?
I'm sorry, John. What's my biggest what?
The biggest
worry?
lesson, sir. The biggest lesson you have.
Yeah, I guess the biggest lesson I have is the U.S. economy is A, very resilient, which I think you just pointed out, and B, it is very flexible as well. It's always changing. And so we always want to, when a shock comes, whether it's a pandemic or whether it's a tariff or whatever, we always want to look back on history to figure out, what the effects of those potential policy changes or those shocks were on the economy. That can only get you so far because, again, the economy continues to evolve. And so history can tell us some things, but we have to stay sharp on our toes about how the structure of the economy is changing and how different policies and different shocks may affect it.
Jay, congratulations on behalf of the team here at Bloomberg Surveillance. Thank you, sir, for your contributions to this show over the years. Jay Bryson there of Wells Fargo.
Yeah, so wonderful to have him on the show, and hopefully he can go back in his new seat. It is important to say we cannot really understand a lot of the policies going forward and extrapolate them out too much. I will say with aluminum foil, I'm looking at prices right now.
That's what you're checking out.
Yeah.
The big takeaway from Jay Bryson, things turn out to be okay, and you're looking at foil and the price of foil.
It's a foil hat.
Right.
It's
on brand. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump said he will push forward with a 50% tariff on imports of copper into the US. The announcement sent copper prices plunging in the global benchmark. Trump looks to spur more mining and smelting in the US, and the tariff can be in place within weeks. And Starbucks has received several proposals from prospective investors in its China business. Sources telling Bloomberg the company is now in the process of shortlisting a group of potential investors for a next round of bidding. In a statement, Starbucks shared it remains committed to China and wants to retain a meaningful stake in the business. And Christian Horner has been let go as CEO and principal of Red Bull Racing after over 20 years with the team. Horner was the longest-serving team principal in Formula One and oversaw Red Bull's rise to dominance in recent years. His departure follows a series of issues both on and off the track over the past year. That should be my brief, John.
Lizzie, thank you. End of an era for Red Bull Racing. Adrian Newey, one of the most successful car designers of all time, if not the most successful. He went recently. Christian Horner going now. Max could be next based on reports we're hearing.
Yeah, that would be kind of a sea change given that he's dominated the field to such a degree and popularized it through the Netflix series, etc. I wonder if they can maintain the popularity if you've got a changing of the guard at the top.
Someone just messaged me, maybe Horner goes to Cadillac, so maybe this isn't all over, so we'll see.
Maybe to Ferrari?
Maybe. We'll see.
Would you like that?
I would like to win. That's what I'd like to happen at Ferrari. Okay?
Okay, all right.
All right.
Duly noted.
Those wins are deep. Up next on the programme, taking aim at copper and pharma.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. They're going to be tariffed at a very, very high rate, like 200%.
Up next, we'll catch up with the former senior Trump trade advisor, Kellyanne Shaw. The president yesterday, tariffs will start being paid on August 1, 2025, and no extensions will be granted. This market didn't even blink. Equity futures positive by 0.2% this morning. On the Nasdaq, up another 0.21. Under surveillance this morning, taking aim at copper and pharma.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
Here's the latest this morning. President Trump vowing to push forward with copper tariffs and giving the pharmaceutical industry a year before slapping a potential levy of 200%. Joining us now to discuss, the former Trump trade advisor, Kellyanne Shaw. Kellyanne, good to see you.
Good to see you.
I'm sure you've been up all night. What's the advice to clients?
My advice to clients is to take the day off, see how this plays out, and then come back in 2 days and a week and see what the tariff landscape looks like. Because right now, this is the end game of a massive, massive negotiation, and there's just as mixed substance as there is theater. So if you're making real business decisions, you're best just taking a beat and waiting it out and see where things land.
Having worked for Trump, is this the final moment where he's trying to extract the most concessions from all these countries?
I think that there is a lot of that in this. And what's so challenging about watching Trump from the outside and what makes him such an interesting negotiator is that there's just as much mix of substance as tactics. And so trying to understand the forest through the trees can be very difficult. But I do think this is the end game. And I think he's trying to say, OK, country X, country Y, you've given me this deal, but are you really going to give me more? And that's what he's trying to get.
Who is the White House most focused on right now?
In terms of the foreign trading partners. So they've talked about these 18 countries. We've heard anywhere from 18 to 30 important trading partners. I think those are the ones that the administration's really focused on trying to land a deal with.
You think this is the end game so that we're going to get some clarity on August 1st? Is that what you're telling clients, that essentially this isn't just a deadline that's going to be moved to September 4th and then October 1st and then on and on?
Well, both, right? So at the same time as we do have this August 1st deadline, and the president doubled down yesterday on Truth Social and said, no, this is a firm deadline. They have also said that if you don't like your tariff rate 6 months, a year, 2 years from now, you can come back and try to lower that through negotiations. So I think we'll certainly see more certainty, and I'm actually hopeful that we do well in advance of August 1st because Customs needs time to adjust the HTS, give importers notice of what those tariff rates are, and that process alone can take a couple of weeks.
I just wonder how much some of this leverage is getting lost in the increasingly extreme rates and the increasingly extreme tactics. Does that actually end up bearing less fruit after using it many times? And that's sort of the question that you see in markets, is a lot of people shrug this off. And frankly, some of the rhetoric that we're hearing from the trading partners saying the same thing.
Well, I think I'm hearing different things from trading partners, anywhere from sheer panic to blasé in terms of some of these tariff rates that have been announced. But what I would say is this is very typical of President Trump's approach to negotiations. And I do think that tariffs will go up. The question for me is by how much and with respect to what trading partner. And so, whether this is the boy who cried wolf, I don't think so at all. I do think that the tariff rates are going to go up, but are they going to go up to 36% on Indonesia? Are they going to go up to 40% on Myanmar? Maybe not. Let's see where things land.
What I'm hearing from you is that his tactics are actually working on the other side of the negotiating table. Would you say that's correct?
Yeah. Having talked to a number of trading partners, there is a bit of let's pick up the phone, find out what's going on, and see how we can de-escalate this happening.
Now, when he comes out and announces something, maybe for India, because he said he basically signaled that yesterday, I had heard that this was imminent. Is it going to be a framework like he announced with the United Kingdom, or we get more substance and details to it?
So India is a bit different than some of the other negotiations that are happening. This is more like a broader trade agreement. So I expect the deal with India to be about a subset of issues. Versus these reciprocal deals, I do think will look more like frameworks with the substance of those provisions and the details to be negotiated moving forward.
Just one point. One dimension of this that I think we will find really interesting is transshipping. How much progress have they actually made so far to stop the flow of trade going from China through other countries and into the United States?
Well, this is an active debate in Washington right now. What does that word transshipment mean? Does that really mean ships that are going from China to a third country like Vietnam and then to the United States? Or is it a reference to this concept of a rule of origin? Meaning if you've got Chinese content in that supply chain, you're going to be paying that 40%, that higher tariff. And if that's the case, Vietnam's between a rock and a hard place, as are many of these countries, because China does not like that idea or that provision. So we'll have to see what the administration means by that when we see the actual text.
Outside of Vietnam, what are the countries you're tracking on that issue?
So the president has had the transshipment issue in every single letter that he sent out. So Japan and Korea have it. I think this means a lot for Southeast Asia because so many companies moved supply chains after the original 301 tariffs and Trump 1.0. So this could really hit them.
Kellyanne, appreciate it. It's good to see you in person, too, here in New York. Thank you. The former senior Trump trade advisor, Kellyanne Shaw, on the difficulties of making some deals right now.
Well, it sounds like what Kellyanne's saying is that this is the end in terms of trying to get to the finish line, which is why you see the president exerting all this pressure and telling clients, take 48 hours. We're not done yet. Take 48 hours, then come back, and you'll see maybe a little bit more clarity.
We'll all take the beginning of the end and not the end of the beginning, right?
I think that's...
I think we'll all take
yes,
that.
I think people would like this to be the beginning of some more certainty because we're all sick of saying the word uncertainty, and so we'd like to move on to another topic.
August 1, are we moving on?
No, absolutely not.
I thought we were moving on July 9th. I was hoping.
Did you actually think so?
I was hoping we'd just get a number across the board, universal tariff. Not that my view matters much, but a universal tariff, and then just move on.
Yeah,
just move on. And pick up on what Savita said over at Bank of America. Corporations will adjust to this. They're resilient. They'll work it out, and they'll move on too.
2 points. Companies are resilient, and they are going to move on. But as far as the uncertainty, well, hope is not a strategy because that seems like it's an ongoing
And we
policy.
just had an entire trade discussion without talking about China. That is something that cloud is going to overhang this administration much of next year as well, because they only are dealing with 2 issues right now. We haven't even gotten to the purchase agreement of Trump's first administration.
Hope is my strategy, all right?
Oh, that's
I'm
so
getting
sweet.
Through life. Hope, that's all you can have. Faith.
Yeah, I think you need a letter
Faith
for
in
that.
your fellow human beings.
Oh, okay. You write a letter on that. I'll write you my letter.
Up next, John Bilton of JPMorgan Asset Management, Sucharita Kodali of Forrester, Nancy Lazar of Piper Sandler, Leslie Falconio of UBS. Put it in the complaint box, right?
Well, the hope is my strategy.
You've got to tell us about that.
Well, I think it's a very good strategy.
You've got a complaint box at home.
Yeah.
And it comes out once a month.
Once a week.
Once a week?
Yeah, so don't tell me
complaints.
my complaints. Just file it in the complaint box. We'll discuss it Saturday morning.
And do you discuss it?
Yes, it's petting.
Then burn them.
And then in the incinerator.
It's still a moving target with the tariffs.
Even the trade deals that are struck, they're still not very detailed.
We're at really high tariff rates right now. In our minds, the next signal points upward.
There's still a lot of story to be told. There's still a lot of negotiations to go on.
It's not a pretty thing to watch, but I think the markets have figured out that this is going to get resolved in the next few months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the open and bow stateside, live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P positive by 0.2%, continuing to shake off the trade threats from the President of the United States. The Nasdaq 100 up by 0.2. If you check out the bond market, the focus is on a 10-year maturity. Yields higher for a sixth consecutive session. Your yield this morning, 441.52. Your day ahead, dominated by a bond auction later on this afternoon at 1 p.m. Eastern Time.
Which will really give us a sense of just how much demand there is for that 10-year maturity at a time where there are real questions around the U.S. fiscal dominance, as well as just this ongoing question around the Federal Reserve Chair. And this is why it matters. We've been talking about it extensively. If the Fed appears pressured to lower interest rates, not based on economic data, but in order to lower interest expenses for the United States, that could cause an exodus from the long end. And that, on the margins, is starting to be the conversation.
BlackRock's Jean Boivin believes this bond market is still a constraint around this White House and their policy on trade. And there's only so much they can push the dial when it comes to tariffs, because this bond market might start pushing back big time.
Well, we saw that on April 9th. Remember when the bond market, to the president's words, got, quote, yippy, and they had to reverse some of the policies when it comes to Liberation Day rates. But we just saw Liberation Day rates once again from this administration, and the market pretty much shrugged it off because they are tempting the president, I think basically saying, boy who cried wolf, you're not going to go through with this. Kellyanne Shaw, though, who was a negotiator under Trump during 1.0, makes a very good point. A lot of theater's going on right now. What the president is trying to do in the final negotiation is push people to the edge. When I say people, other trading partners. And because of that, he wants to get as many concessions as he can. And while the market might be shrugging it off, if you are a prime minister in one of these other countries, you're still second guessing whether or not he means it or not. So you're picking up the phone.
I don't think Kellyanne will mind us saying this. She came into the studio about 15 minutes ago, walked in off mic and just said, take a day off, grab a beer, and wait.
Try to get some more clarity. 48 hours. I said, is 48 hours enough? She's like, maybe a week. This is sort of the moment at which we're in narrative roulette zone. We're trying to understand what the roulette of tariffs is going to look like. We're trying to understand the roulette of what earnings are going to look like when they kick off. Tomorrow we get Delta, next week we get the banks. And the roulette of just what the Fed will do at a time when they're being jawboned. And so we're trying to pick up on these strains at just a time of throwing up the cards, and let's see what happens.
Equities are pretty comfortable with all of this at the moment, close to all-time highs, up on the 0.2% this morning. Mentioned this earlier on this morning in the first hour of this program. Mark Zuckerberg's not freaking out about trade and tariffs. He's going around hiring people at $10 million apiece. What does that tell you about what he's focused on and what's really driving this equity market?
It shows how much the AI trade has still been underpinning so much of this. And that really is at the core of this. And yesterday we were having this conversation where how sensitive are the AI trades to tariffs, to this idea of these levies being put on? And the answer is right now, not very, because that is the future. And if that's the case, you've got price-insensitive buyers when it comes to some of the hyperscalers, particularly with NVIDIA and some of the other chip providers.
Nasdaq futures this morning higher by close to 0.2%. Coming up this hour, we'll catch up with John Bilton of JPMorgan Asset Management as uncertainty limits investor confidence. Sucharita Kodali of Forrester on signs Amazon's Prime Day is disappointing. And Nancy Lazar of Piper Sandler as the pressure builds on Fed Chair Jay Powell. We begin this hour with stock steady as investors digest the president's latest tariff plans. John Bilton of JPMorgan Asset Management writing uncertainty around policy impacts has crimped investor and business confidence, contributing to a likely dip in activity in the second half of 2025. John joins us now for more. John, good morning.
Good morning.
How convinced are you by the slowdown in the second half and why?
Well, I think we've got to look at it economically. We've had a lot thrown at the market. You've got investors who've sort of sat back and wanted to stay on the sidelines, and especially corporations. And we're seeing that come through. Things like the jobs report, it was OK, but it wasn't suddenly sort of taking off. The turbochargers really weren't kicking in at this stage. And we think that we're going through a period where the market is adjusting to the data, the soft data that's come through. And you'll see that leak into the hard data. But make no mistake, if we look beyond the second half, what I think has surprised everybody, ourselves included, is the sheer resilience of the US corporate sector. And as we look ahead into 2026, which is what we think the markets are doing, actually the prognosis is generally better. But it doesn't preclude us having that period of a little bit softer economic activity in the second half.
This is always a challenging call. Can you price the recovery to the slowdown we haven't had yet? Can you do that?
I think what you've got to do is look through it. This is the really key point. If you want to day trade around it, I think you're missing the point. Right now, we've got a corporate sector which has absorbed a lot in terms of the tariff shocks. I think the reason that April 2nd was such a shock was suddenly everyone went, goodness me, he meant what he said. We've got tariffs suddenly have gone from 2.5% to 25%. The reason the markets looked through the copper issues, I think, is if you actually run the numbers, because of the 17 billion of imports that the US has of copper and the significant amount that it self-sources, actually it's about 0.2% impact on the effective tariff rate. And this is a market where we already know that these are coming in somewhere in the middle teens. So the markets have, to my mind, moved on from this. They're looking at the dominance of the tech sector. They're looking at the AI trade. In fact, our quant analytics suggest that the biggest driver of equities this quarter has actually been the AI theme, not the tariff theme. And that's why I think we're making all-time highs.
And this is the reason why so many people have come on this program and said that they like U.S. equities, they don't like U.S. debt. They like U.S. equities, but they're worried about the dollar. There still is exceptionalism. It's just in a smaller pocket, and it has to do with AI. Are you a believer in that?
Well, I think you've got to unpack U.S. exceptionalism. And so there's one level of US exceptionalism, which I think is probably acceptable to the administration, and that's the dollar giving up some of its excessive valuation. We've heard chatter about, concern around currency manipulation. It's never really gone away. But with the dollar weakening, because there's just simply less demand for it, that's taking that issue away. But we're seeing very little evidence of this idea that the dollar is ceasing to be king dollar, the reserve currency. I mean, 40% of global trade is invoiced in dollars, even though the US is a counterpart in only 10%. So, and the institutional strength of the US compared with other regions is still paramount. So you'd need to attack both of those bases before you'd start to unwind the dollar. As for stocks, look, if we unpack the S&P 500, the tech giants continue to be global leaders on relatively decent valuations with strong earnings. The rest of the S&P, actually, it's getting up towards quite peaky valuations. So we do look outside. We look for diversification. Hong Kong, emerging markets, the UK, and Europe's beginning to look really interesting, given the fiscal thrust that's coming next year and the fact that what we're also seeing is the ECB be able to respond with much easier monetary policy because of the disinflationary impulse that tariffs create for the rest of the world ex-US.
So how do you play that? Jean Boivin, BlackRock, was on earlier, and he said that he liked European bonds versus U.S. government bonds, not so much European stocks relative to those in the U.S. Do you agree? I mean, do you prefer European bonds to the U.S. ones because of the ECB's proclivities to possibly cut rates, even in the face of that fiscal expenditure?
Well, so we do continue to like European bonds in preference to the US for the reasons that we think that what's happened with tariffs and all the chatter about national security has actually forged a common purpose for Europe that we've really not seen for some time. And so the spending that's happening, if you look at what's happening with Germany's spending, by the middle of the 2030s, it only takes German debt to GDP to around about 80%. The European Union, particularly Germany, have massive fiscal headroom. And we've got the disinflationary impulse. We've got Europe pointing in the same direction generally now. So it means, some of the periphery markets, the Spanish market, the Italian market, etc., look particularly interesting as a place to pick up carry, pick up some decent returns there. But I wouldn't write off European equities right now. Yes, they're a little bit more expensive. But if I told you at the beginning of the year, you know what, we're going to see European earnings expectations for 2025 go from 8% to 1%, what would you think the market would have done? You wouldn't expect it to have been up 10% year to date. The market now is pricing a very shallow forward earnings curve just at a time when we're about to see a significant fiscal and monetary boost. So we're beginning to get quite excited about the European asset market in general, but certainly leading off with the bond market.
But aren't European equities going to be the most exposed when it comes to the tariff risks?
Well, I think what we've already seen is that's been priced through the earnings forwards. So we have got Europe trading at around about 15 times forward multiples, which is significant premium to where it's been over the last 10 to 15 years, albeit that was a period when Europe was resetting its balance sheet with regard to the bank's post-Eurozone crisis. So, yes, there's a lot of tariff potential impact, but we also have one of the most powerful negotiators out there, the European Union. And so I do think that some of the saber rattling that we're seeing from the White House should be taken seriously in terms of thinking what it means for Europe. But make no mistake, Europe are incentivized to come to an agreement and move forward. But what it's also doing is it's forcing Europe to look inwards. It's the biggest consumer market on the planet. It's twice the size in individuals of the United States. And we're beginning to see self-help, fiscal spending, monetary support. And as a result, I think what we can see is a little bit more potential for Europe to play catch-up.
You're laughing at the Europeans.
Well, it's self-help. Chicken soup for the European soul. I just picture this. There's nothing quite like having a common enemy. That's all I
They
can
need
say.
it. Right now, they've got to eat Chinese deflation. I was looking at PPI out of China overnight, the 33rd month of negative factory prices out of that country.
Overproduction. Yeah, overproduction. And where is it going to go? And that's really a question. And that's part of the reason why the ECB may have the ability and desire to cut rates.
The ECB doesn't look comfortable right now. I have to say that. Listening to the officials in the last week or so, you make it sound quite straightforward. I agree with you, it should be. But that's not what I'm hearing. They're worried about the FX channel and then doing nothing about it.
But look at it in terms of euro-dollar versus trade-weighted euro. Excuse me. Euro-dollar has moved around 12-13%. So that's significant for that currency pair. But of course, in trade-weighted terms, the euro's moved around 7%. So meaningful, but bear in mind that the bilateral trade with the US, while clearly important to Europe, is not the only barometer that they look at. We're just beginning to see a little bit of nervousness coming out in terms of some of the commentary from Sintra around the level of the euro, but I don't think this is in any way panic stations yet. And, if anything, when we look at it against our long-term fair value, again, going back to euro-dollar, we see fair value somewhere around 125. So pushing up to the upper teens, perhaps the 120 level this year, I don't think is going to scare the horses at the ECB too much.
John, it's good to see you.
Good to
As
see you
always,
too.
thanks for dropping by. And thanks for trying to explain what Charlton Athletic is to Annmarie in the commercial break. Good attempt. John Bilton there of JPMorgan Asset Management. What did you say? That's not a real football club?
Well, it sounds a little
said?
bit like a Mickey Mouse football club.
OK. Hope Charlton's not listening this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
From a Charlton fan, John, not happy about that. Here's your news, though. Investigations are underway in the deadly Texas flash flood. They're looking into when weather forecasters advised local officials about flooding and what those officials did to spread the message to thousands in the area. The floods killed over 100 people and 161 are still missing. Elsewhere, the Supreme Court gave President Trump approval to cut the size of the federal government. The decision lifted a court order that blocked federal departments and agencies from slashing their workforces. The coalition of federal employees, non-profits and local governments said that the decision, quote, dealt a serious blow to our democracy. And finally, US consumer borrowing increased in May at the slowest pace in 3 months. Federal Reserve data shows credit card and other revolving debt outstanding declined $3.5 billion, the first decrease since November. Non-revolving debt, such as loans for vehicle purchases and school tuition, increased $8.6 billion. That should be the brief. John.
Lizzie, I had no idea. I apologise on behalf of the programme. Up next, the Morning Calls Plus. Sucharita Kodali of Forrester on signs Amazon's Prime Day is set to disappoint. Their conversation's next. Live from New York City this morning. Good morning. So here's the runway for the next month or so. July 15th, CPI. 2 days later, retail sales. Go on to July 30th, a Fed decision. 2 days later, August 1 payrolls the same day for the next trade deadline. A lot still to come over the next few weeks. Equity futures at the moment grinding higher into it, up 0.2% on the S&P, on the Nasdaq up by 0.2% also. That's the price action. Here are your morning calls. First up, Oppenheimer upgrading Microsoft to outperform, seeing the company as one of the long-term AI winners in software. That stock is up by 0.75%. Your second call from Barclays, raising its price target on Netflix to 1,100, writing legacy media earnings could surprise to the upside. And finally, Citi raising its price target on UBS to 127, seeing balanced risk-reward for transport stocks due to a still soft demand backdrop. The stock is positive by 0.6%. Let's stick with a consumer. Amazon seeing a sluggish start to its annual Prime Day sale, with sales falling almost 14% in the event's first few hours compared to last year. Bloomberg's Poonam Gaur joins us now for more. Poonam, welcome to the programme. I think our first question, our only question really, is whether this is an Amazon problem or a consumer issue.
I think it's a little bit of both, but you have to remember that the event is 4 days this year, not 2 days. So consumers have time to come out and spend.
Is brand Jeff Bezos and the recent wedding dent the enthusiasm over brand Amazon, Poonam? Do you see any of that at all?
I think consumers are looking for deals right now, and Amazon's providing the deals. So I think most will just focus on the deals and their budgets to maximize them, which Amazon and other retailers are providing them to do this
What's
week.
tickled you?
Well, I think that's just funny because I do now think of Amazon. I'm a little bit like, oh, is it a little tacky?
Based on the wedding?
Based on the wedding, yeah.
Okay.
Also, the
That's your
deals.
association with
Also,
them now.
the deals. They're saying these deals for the AirPods are supposed to be the best, but if you Google them, you can get the same exact price on Walmart, and they're not having some special Walmart day. So I don't really know if there's real deals to be had.
Poonam, we saw plenty of pull forward in the first few months of the year. The threat of tariffs hanging over the consumer. There is an open question as to whether we've worked through a lot of that pre-tariff inventory. How much inventory is left?
I think there's very little pre-tariff inventory left. As far as what I'm seeing and what I'm hearing from retailers is that 2Q deliveries have the tariff rate built into them. And as the rates are subject to change over the next 2 quarters, especially holiday, prices could rise even further. So deals still matter, and they still matter a lot. I'd say, we'll know a little more in the next day or two. I did see data this morning from Numerator, which basically said the first 16 hours of Prime Day, the average order size was a little over $58. And if you compare that to last year, the first basically more than 30 hours, the average spend was over $60. So there is a deceleration, but I'd say there's still time for people to come and shop.
Poonam, appreciate your time. As always, Poonam Gaur there of Bloomberg Intelligence. To extend the conversation, Sucharita Kodali of Forrester writing, retailers will be more cautious about discounting too early in the year should there be supply chain issues or heavier hitting tariffs. Joining us now, Sucharita. Sucharita, let's just talk about the tariffs so far and pick up on that last question that we asked Poonam Gaur. The amount of pre-tariff inventory there is still at these retailers for them to work through, or are we getting to the point where they've got to make a bigger decision?
Well, there are so many factors to consider with tariffs and the amount of inventory that you're going to hold, because retailers just don't have an infinite amount of cash on hand that they can invest their working capital in this inventory that they want to front load. So it is a balance between front loading the things that you know are definitely going to sell and are not perishable and will be able to have some shelf life, while also maintaining the reality of how much you're likely to do in sales. If retailers pull forward too much inventory, what they end up doing is that they're risking cash flow, and ultimately the lack of cash flow is what drives retailers to bankruptcy.
Sucharita, if you put this all together, what does it say about the prospect for deals? We were looking through Amazon for deals and not finding as many as we have in the past. That doesn't speak of desperation to clear the shelves of any existing inventory.
My hunch is that marketplace sellers were probably a little bit more cautious with what they were able to offer Amazon in the first place. Amazon works by everything that sellers have shared with us. They work long in advance to get the deals. And what has likely happened is that tariffs earlier this year threw a wrench into things. And as a result of that, we just saw prices likely going up, not substantially, but enough that you wouldn't necessarily see the great deals that you'd see otherwise. So it's not surprising that likely there are more categories that are now offered for sale. We certainly are seeing a greater number of days. And over the last few years, we've seen multiple Prime Days. Amazon now runs this event twice a year. They have it in July and October, in large part to be able to comp the previous year's numbers.
Which really goes to the point of how much can we really gauge or extrapolate out consumer demand from these numbers at a time where I know that in my household, every day is Amazon Day, and it's sort of how many things can you possibly buy? I just wonder, is that sort of your read through? Is that both the sellers aren't really offering amazing deals, they're kind of not buying into it quite as much, and the buyers aren't rushing to front load their orders because they can do it at any time? Is that kind of what we're seeing? And it kind of takes the winds out of the sails of people who say this indicates that consumers are falling off a cliff.
Right. I think that what you've just suggested, which is the truth, is that consumers are honestly a little bit jaded by some of these offers that are out there. So there's the combination of the fact that they are not as excited. And by the way, when you have multiple types of offers over multiple days, we've even seen sort of the drop off happening around Black Friday and some of those key dates that historically during the holiday season were big selling dates. But as you add more, as more retailers have more products for sale, it's just not as special anymore. So you have the jaded shopper. And then on top of that, we have all of the economic issues, the consumer confidence issues, and the fact that that we did front load a lot of transactions in Q1 and Q2. Retail continues to be fairly resilient. And a large part of that was the pull forward that we saw earlier this year due to the threat of tariffs.
Sucharita, you mentioned in your note later in the year where there could be supply chain issues. What kind of supply chain issues are you starting to think about potentially that some of these retailers could be hit with?
Well, it's really if there are ultimately some of the tariff discussions do actually come into place. So a lot of what has happened has been the threat of tariffs. There are some regions of the world, some product categories that are facing higher costs, like in China. But for other parts of the world, there's essentially been a moratorium. But that led to a lot of uncertainty and a lot of concerns around, well, let's get ahead of this and let's pull forward whatever we can, both from a consumer standpoint as well as a merchandiser standpoint for wherever that was possible. Now, we are coming up to the 90-day limit, and what we may see is the resumption of some of those threats of tariffs, even in regions in the world where we haven't seen them before. So other parts of the Far East or India or even products coming from Europe. So in that case, in that scenario, you're absolutely going to see either higher prices, which will lead to inflation, or you're going to see just lower inventory availability because the retailer is simply going to be buying to what is absolutely essential and not have any excess inventory in stock.
Sucharita, great to get your thoughts. Sucharita Kodali there at Forrester, the latest on Amazon Prime Day and what retailers are doing. It's a process, and that process is continuing. They had to work through a lot of pre-tariff inventory, and then we can figure out how much they're going to take on margin. Once we figure out how much they're going to take on margin, you can start to do some sums about what it could mean for cost cutting elsewhere, including the labour market. And that might be months and months down the road still from here.
So if you're looking for clarity, maybe hope can be your strategy. But right now, it doesn't seem like that's the case. As we were talking, I got an Amazon Prime email tailored for me.
Finally, what you
with
get?
Some specific deals, 25% off socks, 32%
foil
off handheld steamers, 45% against hand exercisers. This is the kind of stuff I'm revealing way too much about myself. Yeah, exactly.
What bears like
hats. Gold bars.
Yeah, exactly.
Yeah, exactly.
Yeah.
That's
that long life coffee and all of that stuff.
Yeah, there's emergency packs that you
seen
put
those
in.
preppers.
Yeah, totally. That's what I'm saying.
Yeah, I find that fascinating.
What are those meals called? Where it's sort of like the forever bar that you can eat that can give you some sustenance.
I forget, but they're pretty gross.
Have you tried them?
No, I don't want to either.
Okay.
Let's hope we're never in the circumstances where we have to eat that stuff. All right. Coming up on the programme, Nancy Lazar of Piper Sandler as the pressure builds on Fed Chair Jay Powell. Plus, Yahira Anand with your morning movers and a big deal for Big Pharma. Live from New York, this is Bloomberg. The open about 16 minutes away. Equity futures positive by 0.2%. A struggle to bounce back from Monday's trade-related losses, but a mild day of losses in yesterday's session. A small bounce on the Nasdaq 100 up by 0.2. In the bond market, 2-year, 10-year and 30-year. A focus at the front end of the curve and the big Fed debate. Yields higher by a single basis point at 390.32. Further out along the curve, a big conversation about the prospect of inflation firming, plus what could it mean if you get a Fed chair that comes along and does exactly what the president wants long before the data demands it? Will that contribute to higher long-end yields? This morning, 441.52, yields higher for a 6th consecutive session. We're higher by another 2 basis points. That's the cross-asset price action. Let's cross over to Yahira Arnott for some single names. Hey, Yahira.
Good morning, John. We start with some big news in the pharma space, some deal news that we did talk about earlier, but now it's official. Merck has agreed to buy the UK biotech Verona Pharma for about $10 billion. So as a result, take a look at Verona Pharma. It is up more than 20%, and it's a strategic bet for Merck on respiratory medicine at a time when it's trying to diversify. That's because its top-selling cancer drug, the patent on its top-selling cancer drug is expiring soon, so it is looking for ways to offset that. Next up, we have a really big mover in RX site. Shares are down nearly 50% now. That's because the company, which makes lenses used in cataract surgery, slashed its 2025 forecast by $55 million. A big shock to investors, as you can see, and it's spurring a number of downgrades this morning. And we end on Starbucks, rising 3% now on our reporting that the company is considering selling a bigger stake in its China business. That's a shift since Starbucks had originally planned to keep a tight grip by only selling a minority stake. But with sales struggling and competition heating up in its second biggest market, we're reporting that it is sifting through offers and narrowing down a list of potential investors to try and make a deal. John?
Yahira, thank you. Thanks for this morning. Appreciate it. Let's get to the day ahead. It looks like this. Fed minutes later on this afternoon, another Treasury auction at 1 p.m. Eastern Time. $39 billion of 10-year notes. With the latest, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. I think today probably the Fed minutes will get some attention, but given the fact that the president is going to be releasing more tariff letters today, by the time we get to the Fed's discussion of what they were thinking 3 weeks ago, it may be mostly irrelevant, although people will be looking to see what the discussion was about why they kept 2 rate cuts in the forecast for the year. Now, as far as the 10-year, the question has been, are we going to see some sort of buyer's strike by people from overseas who are unhappy with the United States? And the general feeling on Wall Street seems to be not yet, that there's enough demand out there. There might be a little supply concession, but overall, there's still demand for 10s. And any real movement based on what the president is saying about Jay Powell and others would really occur at the 2-year level for the moment.
Mike, any thoughts on the Fed race? Kevin Walsh versus Kevin Hassett, and whether we're seeing some auditioning already on the FOMC?
Well, I think there's been auditioning, definitely auditioning. I think that Kevin Walsh is probably the favorite still. Kevin Hassett, very loyal and probably seen as the guy who would push for lowest rates. But what kind of reception would he get on Wall Street? That's something that Scott Bessent is going to be have to be weighing when he gives advice to the president about this, assuming that Mr. Bessent isn't putting himself forward. And then the question that they keep raising is, what if Jay Powell doesn't quit as a governor? They would only have 1 seat. They'd have to put the new chair into the seat that comes up in January. And so does that mean that maybe they keep Chris Waller in reserve just in case they can't get somebody else?
This could get messy. Mike McKee, appreciate the update. Looking forward to your reporting throughout the day. Michael McKee there from Jackson, I believe. Over at an economic forum over there?
Yeah, they do a lot of economic forums in Jackson, Wyoming, evidently.
Why not? It's any excuse, right?
You know, can we just separate out the drama and have that sort of like, you can watch the melodrama if you want to, but then watch paint dry over here, which is the actual policy, which is going to depend on all this economic data that's going to come through the fore. I think that would be great.
We'll do that right now.
Okay, cool.
If you want. Nancy Lazar of Piper Sandler with this to say. Investors might be done with tariffs, but we doubt Trump's tariff agenda is done with investors. Nancy joins us now for more. Nancy, good morning.
Good morning.
What is guiding you at the moment? What convinces you of that?
Well, to be sure, this administration wants higher tariffs. They've already put in higher tariffs, and they're going to stick. We've accepted the fact that tariffs are here to stay. Why? We do need a freer trade backdrop. And two, I think misguided, this administration thinks this is positive for the United States. I'm a free market economist. Tariffs are a bad idea. Nonetheless, I have to accept that they are indeed here. and they're going to be a negative impact on the economy. It's a regressive tax on consumers. Lower-end consumers are going to get hit more because of these higher prices, and same for small and medium-sized businesses. Larger businesses might be able to plow through this, but the smaller, medium-sized part of the economy are going to get squeezed from these higher prices.
When you take the politics out of it, is this more inflationary or more of a slowing growth type of ramification from the tariffs?
Well, near term, it's a tax. It's a hit on the economy. Whether or not it turns into sustained inflation depends upon what both monetary and fiscal policy do. I would worry about the Fed stepping in and cutting rates too aggressively here, because that would just increase the odds that these price levels indeed stick. When you've seen tariffs before, when we had some back in 2018, it was a price shock. You saw it in furniture, household appliances. You initially had that increase in price, but then you had a decline in demand, and that eventually led to a lower prices actually for household appliances and furniture. So it depends how sustainable these are on what the Fed does.
I want to just hone in on something that you said. If the Fed cuts, you think that would lead to more protracted price increases and more sort of entrenched inflation. What gives you the confidence to say that at a time where we're seeing on the margin some slowing in consumer spending and certainly deterioration in consumer confidence?
Well, as we saw, and this is nowhere near as extreme as we saw during the COVID crisis, you can have a temporary shift down in demand, but inflation is a function of what the Federal Reserve does, monetary and fiscal policy does. So even though you had that shift down in demand in 2020, because both monetary and fiscal policy eased so aggressively, you then net had price levels stayed elevated with that supply chain disruption, and then you had the inflation in 21 into 22. So near term, yes, we are having a shift down in demand. Which could lead to lower prices, say, later this year, next year. But if the Fed were to cut rates too aggressively, then I would, again, be worried about inflation in 2026. And I thought your point on the bond market here is going to be really important. The Fed cut rates last year, 100 basis points. Everyone seems to forget about that. They cut rates 100 basis points in the fall of last year. What did bond yields do? They rose 100 basis points. So the Fed controls the short end of the curve, and I think some of the administration understands that, but they have to be careful of the long end.
Will the Fed have enough information to cut by September, given the fact, especially that the tariff deadline has been pushed out to August 1st?
I worry about that because we saw that the employment report on the surface looked healthy. Underneath the hood, it was actually a weak employment report, but on the surface, it looked healthy. I would have thought it would have been easier for the Fed to have cut rates here in July, where you really still have tame inflation and signs of an economic slowdown. I worry by September. You could have maybe clearer signs of a weaker economy, but stickier inflation. I am hearing from retailers that they're done with inventories. The pre-tariff increase in inventories, they're fading. Now they are going to be selling these higher price products in the third quarter related to the tariff increases. So I worry about September.
But a cycle or one price adjustment?
Again, for right now, it's a one price shift up in price, as we saw in 2018, but we don't have the conclusion. It depends upon how aggressive the Fed is.
When you say you're worried about September, are you worried about the price side of things? Yeah. Or are you worried about what could happen to the labour market if they have to absorb some of this on margin?
Well, I think you're going to increasingly hear stagflation as you go through the third quarter, because already you're seeing consumer spending stalling out. Already, again, under the hood, the labour market is deteriorating. Unemployment claims are probably the easiest number to show that, cleanest number to show that. So I worry that as you go through the third quarter, the Fed is going to have to really balance it. On one hand, you will have a weaker economy. GDP growth, we have less than 1% in the third quarter, probably a higher unemployment rate. But then the inflation data could be also more sticky, and you're seeing it in the data. Shelter was a headwind to inflation in the second quarter. Is that going to continue into the third quarter as these tariffs make their way through into the data?
And that's, as you know, there's a range of views at the Federal Reserve. This FOMC is incredibly divided. One view, I think is quite important at the moment, is Governor Waller's view. And Governor Waller is making, I think, a credible argument to say you should look through the inflationary effects, potentially, of tariffs, and maybe think about reducing interest rates. Do you find that particularly compelling?
I don't. One, I think if you look through the tariffs in aggregate, the economy actually is on a healthier footing. This is a soft patch. Volatility created from the uncertainty and the tariff and the price increases. As I've said before, and I focus a lot on capital spending, you have incremental fiscal stimulus for 2026, importantly for capital spending, which has boosted potential GDP growth already. You don't need a lower interest rate environment, as some of you have reported this morning. There's a lot of liquidity in the markets. That's why this M&A cycle is picking up, and I would be leery in cutting rates too aggressively. One, the economy is healthy with stronger potential GDP growth. We have basically a 4% unemployment rate. Cyclically, it's going to go up a little bit, but we don't need lower interest rates. This is not 2008-9. It's not a COVID crisis. I think rates should stay where they are.
So, John, I was thinking as Nancy was talking, if you wanted to explain stagflation, there is one economist, Donald Trump, who really put it perfectly when he said just a few months ago, maybe you need just $2 that cost a little bit more rather than 30. And maybe that's what we're seeing trickle out into the economy.
Is that the argument he's making now?
I don't know if he really wants to go back to that.
Quite the same thing.
Maybe not. I do wonder, though, about where the inflation comes from. If you do see consumers in not as strong of a position, you pointed to the labor market and the weakening that we're seeing in certainly the private payrolls report. Where is it going to come from in terms of fueling the ongoing ability to absorb the price increases?
So it will have to come from stronger corporate profits. I mean, because if you have a stronger corporate profit backdrop, then you'll get a stronger labor market, you'll get bigger wage increases. And so near-term profits are under pressure. 2Q earnings are probably going to decline, not year over year, but sequentially, which is why you have this weaker labor market. So you need this soft patch to end, which we think can end on its own without lower rates in 2026. Because of this incremental fiscal, and importantly, because of the capital spending cycle. And so the investment cycle fuels productivity, productivity fuels profitability, and that then net is how you get a stronger job market.
Nancy, we hope you're right. It's good to see you.
Nice. Thanks for your time.
Thanks for dropping by. Thanks for your time. Nancy Lazar there of Piper Sandler. Equities at the moment positive by about 0.2% on the S&P, with an update on stories elsewhere with your morning brief. Your Bloomberg brief. Here is Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump said he will push forward with a 50% tariff on imports of copper into the US. The announcement sent copper prices plunging in the global benchmark. Trump is looking to spur more mining and smelting stateside, and the tariff can be in place within weeks. Elsewhere, a leadership shake-up at Apple. COO Jeff Williams is retiring from his post later this year, with plans to continue to oversee the design team and to manage health initiatives. 30-year Apple veteran Sabi Khan will replace Williams as COO. And Tesla CEO Elon Musk telling Wedbush analyst Dan Ives to, quote, shut up in a post on X. His comment coming in response to Dan's call for Tesla's board of directors to get involved after Musk unveiled his bid to start a new political party. And that's your Bloomberg Brief, John.
Lizzie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead, plus Leslie Falconio of UBS as investors face President Trump's latest tariff threat. From New York City, this is Bloomberg. Mild gains so far this morning, positive by 0.25% on the S&P, on the Nasdaq up by 0.2%. The day gets busier as the session grows older. Your day ahead looks a little something like this. 1 p.m. Eastern Time, the US Treasury auctioning $39 billion in 10-year notes. 2 p.m. we get some Fed minutes. On Thursday, we'll get Delta earnings, so look out for that, alongside some jobless claims and another auction, this time 30-year notes. The focus on economic sentiment results from Delta Airlines tomorrow morning. Leslie Falconio of UBS writing the following. U.S. consumers and businesses increase spending in advance of actual and threatened tariff increases. That boost is now fading and will begin to drag on growth in the second half. Leslie joins us now for more. Leslie, thanks for joining us. Just to build on that particular quote there, where do you expect to see that show up and how soon?
Well, I mean, we're expecting in the second half, probably not. I mean, obviously the GDP in the second quarter is going to be strong. We're going to start to see probably some slowing growth in, the third and fourth quarters, simply as we've had a pull forward in both businesses, and consumers. So our expectation is that the Fed does cut in September, twice this year, but for a total of about 100 basis points. So we're looking for about 25 basis points consecutively each meeting starting in September.
Some debate at the moment between a lot of people as to whether they should price the recovery in 26 off the back of the rate cuts that we might see from September onwards, or the slowdown that you're forecasting for the second half. Which one?
Well, listen, I think it's a sequencing issue, right? I think people are focused on tariffs right now and the cost that tariffs will have in terms of consumer and, therefore potential inflation. But in 2026, it's going to be more about tax cuts. So I think it's more about a sequencing issue. And if, in fact, growth does slow, again, not collapse, we're expecting these non-recessionary cuts, and you have some stimulus in 2026, you could see an upward trend growth. And I think that's what the market's paying attention to.
One of the big challenges here is the inflation picture, and we're saying this ahead of next week's CPI report. I'm looking right now at five-year break-even rates, basically the expected inflation over the next 5 to 10 years as baked into derivatives. And it's actually at the highest level right now, going back to February. And I just wonder if the Fed has the bandwidth to cut rates the way that so many people are expecting, including yourself, given that there is this fear that is percolating into certainly markets, if not into what we're hearing from retailers.
Listen, there's no question, and you've talked about this before, and I happen to agree. If the Fed does cut prematurely, you do run the risk of that back end moving higher, and you have this really large bear steepener. But even though the five-year inflation might be up a little bit, it's still very well anchored. And when you look at some of the components of service inflation, I know we've been focused a lot on goods inflation, but if you look at some of the components of service inflation within, say, the CPI, OER year over year is down. Auto insurance year over year is down. So there are these service inflation components where you haven't seen this really large spike. But to your point, Lisa, it's definitely something that the market is going to be watching. And there's no question that market perception, if the Fed does cut too early, is going to react before the actual fundamental data is shown. And that's really the risk that the Fed faces right now.
So at 1 p.m., we've got $39 billion of 10-year bonds being sold. And then tomorrow we have $22 billion of 30-year treasuries also being auctioned off. How closely are you watching the internals, the dynamics, to understand just exactly what the zeitgeist is in markets that could drive action and potentially even your strategy?
Yeah, I mean, look, we're watching the 10-year auction today. We do expect some concessions. There's no question. It's not, just because we've had some, renewed tariff headlines and maybe this is, will increase inflation going forward. But a lot of this has to do with the fact that we had a strong jobs report. People came into that job report, I think, long duration, and they had to shed some. So I do think we are expecting some concession into the 10-year Treasury auction, but we still expect it to go well. And again, our, point on the curve since going back to 2024 has been to stay in the intermediate and that 5-year or the yield curve. And that's really worked out well for us. It's been a great hedge during those pockets of vulnerability in the equity market. It's had a great total return. And we're often asked, when would you extend? When would you move your duration out? Listen, it wouldn't be impossible or a small probability that we see the high of the 10-year Treasury yield that we saw in January around that 480. Would we start to extend and have that buy the dip mentality? We absolutely do, but we're not rushing in.
Well, what would make you get there, though? Like, what could be the catalyst?
In terms of rising rates?
Yes.
Yeah, I mean, listen, it could be, one, the Fed cuts prematurely. Two, obviously, this inflation that we're seeing turns out to be a bit higher than what we expect. And when I'm saying that, it's not just having inflation come into the numbers, but how quickly it does. Right? If it's this gradual rise in inflation, then that's one thing, or if it's much quicker than what we're expecting. I mean, if you look at PCE projections at the end of the year at about 3.5%, you still have to run a 3-month average about 4. So, I mean, in those kinds of, numbers, I think would really move those yields higher. I don't believe it's deficit driven. I've said this before on your show. I think, supply is a passenger, not a driver. It's about inflation and growth in that long end. But if you do see something that inflation's coming in faster, right, than what people are anticipating, then you could get it.
You said earlier the market right now is focused on tariffs, but next year it's going to be 2026 is going to be about the tax cuts. What tax cuts specifically? Because what we saw in the One Big Beautiful Bill in terms of the big chunk of the cuts, it's only an extension of the current policy we have today.
You're absolutely right. And I do think that, the market's perception of, I think, when we look at, especially if you look at 7% of deficit versus nominal GDP, if most of that GDP is already into the marketplace, and I agree with you, then I think what the market is looking at in terms of the benefit of terms of whether it's CapEx or the fact that it does believe that the Fed does cut, which should fuel growth. And I think that also no one expects third and fourth quarter growth to be, incredibly high. Even though we're looking at a 1.5% GDP in the fourth quarter, those third and fourth quarter numbers are going to be below trend. So I think you're going to have that upward slope in terms of that growth outlook in terms of 2026 as well. But that is the risk. There's no question.
Leslie, appreciate your time. Leslie Falconio there of UBS, looking ahead to a whole bunch of risks in the second half. Look at this right now. Peter Navarro, trade advisor to the President of the United States, saying Apple thinks it's too big to tariff. Apple just moments ago turning negative in the pre-market, down about 0.2%.
Yeah, this just points to the idea of you have to be in the good graces of this administration. If Apple was looking for a carve-out, Peter Navarro isn't the one that's going to give it to them, and they aren't going to be the one to really signal it either. I do wonder how much the president is going to pit himself against the tech giants that have gotten so much of the preeminence in U.S. equity markets.
And what's interesting is because everyone says India is going to be that deal that the president announced in terms of a framework that's imminent. What have we seen over the past few years when it comes to Apple moving supply chains out of China into India? Potentially, they're going to be hit with a rate that's going to make it very challenging for them. And Peter Navarro, he's not at the negotiating table, but he is very close to the president. He goes in and out of the West Wing, and he has the president's ear, and he's saying that maybe Apple is going to be one the president looks at next.
Apple is not having a good year so far. The stock is down by about 16%. Tariffs is one story. Meta going after their talent is another story. Here's one more. This from Peter Navarro. The Fed should cut rates in July.
This is my shock face.
Who hasn't said that in this administration?
This is sort of the on-point message that you have to put out there. They're too late. It's too late, Powell. Not even too late, Powell. It's just too late. That's his name, TL. And, he needs to go now. I guess there is a growing number of people in markets who agree with them. It's the argument that they make and how salient that will be, because if it is about the deficit and lowering costs, that is not going to resonate well with markets versus a discussion about slowing inflation and a lack of inflationary pressure coming from the labor market.
Neil Dutter of Renmac just moments ago saying that Trump has created a litmus test for his Fed nominee. They have to agree to cutting interest rates. This makes nearly all of the potential candidates look totally compromised. Went on to say this: if Trump values feeling the market, he may end up having no choice but to pick Governor Waller, an argument that Neil's made a few times.
You need the credibility in order for the Fed, to your point that you said earlier, to have the ability to cut rates, because ultimately it depends on that credibility that they will be willing to hike rates if there is a problem with inflation.
We've all said this repeatedly. There will be two votes, one at the Senate, and before it gets there, one in this market. And this market will vote very quickly about the credibility of whoever the candidate is. Coming up on the programme tomorrow, the lineup looks like this. Liz Ann Saunders of Charles Schwab, Mike Zezas of Morgan Stanley, Holly O'Neill, the President of Retail Banking at Bank of America, and Oksana Aronoff of JPMorgan Asset Management, plus a special guest, the former US Vice President, Mike Pence. Live from New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.